Since we're already over 400 of you here, let's get started with the session. Big welcome everyone to this half day of training on applying the IFRS Sustainability Disclosure Standards. My name is Fiona Quinlan Wells, and it's a pleasure to be with you on behalf of the UN SSE team. So this training program is really a very collaborative effort, as you'll see from the number of organisations represented on our panel today. So firstly, just my heartfelt thanks to the IFRS Foundation, to the IFC, and our wider colleagues for their support for this program. And of course, a big thank you to all of you for taking the time to join us as attendees at this training workshop today. We really appreciate your commitment and interest to building your knowledge on this emerging topic. So brilliant. So to get us kicked off in the session today, we have a couple of opening remarks. So firstly, I'm very pleased to introduce Veronika Pincheva, who is an ISSB board member. So a big thank you for joining us today, Veronika, and the floor is yours.
Thank you so much, Fiona, and good morning, good afternoon, and good evening to everyone joining us today. And indeed, from so many parts of the world, I'm really impressed to see all you guys introducing yourselves in the chat. It's a real pleasure to open this session and to see such strong interest once again in sustainability-related financial disclosure. On behalf of the International Sustainability Standards Board, I would like to thank the United Nations Sustainable Stock Exchanges for convening this session once again, and also to the IFC for its continuous support and partnership. This program has become somehow something like a global movement. Through UN SEC sessions like this one, more than 20,000 market participants have already engaged with the ISSB's work. And this tells me, at least, something important, that there is a genuine appetite across markets for clarity, consistency, and decision useful information on sustainability. Today's sessions will focus again on IFRS S1 and S2, our first standards. And these standards were developed with a very clear purpose in mind: to help companies provide investors with high quality, globally comparable information about sustainability-related risks and opportunities, starting with climate. And they're about bringing sustainability information into the core of financial decision-making, using concepts that markets already understand and use. I think that many of you joining today are not new to this conversation. You may have attended previous UN SEC sessions, worked with ISSB staff, or followed the standards through their development and early adoption. And that experience matters because it reflects the reality that implementation is a journey, not a single moment in time, and that learning happens through dialogue, examples, and practical questions. Therefore, I believe that this session is not just an introduction, but an invitation to deepen your understanding on how IFRS S1 and S2 are designed to work together, an invitation to reflect on how the standards can support your own market objectives, whether you are an exchange, a regulator, an investor, or a company, and an invitation to stay connected as this global baseline continues to be adopted and built into market practice. With that, let me thank you once again for making the time to join today and to wish you a very engaging and useful session. And I look forward to the discussion and to our continued collaboration through the UN SEC community. Thank you.
Thank you so much for that, Veronika, and for your kind words. Indeed, we're delighted to continue to collaborate together on this program and look forward to training the next 20,000 participants together as well. So thanks very much for joining us. And with that, I'm delighted to introduce a second representative from our other partner program for this training, the IFC, part of the World Bank Group. So I'm very pleased to introduce Chuck Canfield, the Global Manager for Corporate Governance at IFC. So thanks for joining us again, Chuck, and over to you.
Thank you. Thanks, Fiona. Thank you, Veronika, as well. So I'm Chuck Canfield, manager of the IFC Corporate Governance Unit. It's a pleasure to join you for the first global workshop of the year on IFRS Sustainability Disclosure Standards. This session reflects a strong and growing partnership among the UN Sustainable Stock Exchange Initiative IFRS Foundation, and IFC's Beyond the Balance Sheet program. Together, we have launched our ISSB training in January of last year. And since then, it's reached more than 22,000 participants across 35 markets. The scale is possible because of collaboration, bringing together global expertise, local relevance, and a shared commitment to improving disclosure. Today's turnout reflects that momentum. We've had 1,800 people register for this session, and I think we're at about 400 to 500 people right now. This speaks to the rapid global shift towards transparency, sustainability, and effective risk management. The ISSB standards play a unique role in this transformation. They bring much needed consistency and convergence to sustainability reporting, with a focus on high quality, decision usefulness information for investors. Today, 36 jurisdictions have adopted or are in the process of incorporating these standards into their regulatory frameworks. IFC is actively supporting more than 10 of them, including South Africa, Peru, Bangladesh, Nepal, Jordan, and Pakistan, through our regional corporate governance advisory work. This work is especially important for companies and banks, given their central role in contributing to assessing and pricing sustainability related risks across entire economies. Our program, the Beyond the Balance Sheet program, is our flagship program for strengthening transparency and sustainability reporting in emerging markets. Through our toolkits, our e-learning program, and our hands-on advisory services, we've reached over 40,000 participants in 100 markets. We have a simple goal to help companies and financial institutions integrate and disclose sustainability into governance strategy and risk management, where it influences important decision making. Your participation today demonstrates a strong collective commitment to improving disclosure quality and aligning with good global practice. I encourage you all to engage actively, ask questions, and make most of the expertise from ISSB, UNSSC, and IFC. Thanks again for joining us, and thank you for your leadership in advancing sustainability, transparency, and prosperity. Fiona, back to you.
Thank you so much for that, Chuck. Really appreciated. And I think sets an excellent tone for today's session. So big thank you again to Chuck and Veronica for kicking us off there. Great. So from my side, I'm just going to cover a few practical points about how today's session will work, just to make sure that's clear for everyone before we get kicking off into the content. So firstly, you've probably noticed by now as participants that you're muted in the session, but that really doesn't mean that we don't want you to interact with us. So it's great to see so many of you already messaging in the chat to introduce yourselves and make comments. Of course, we're a busy session with a lot of us here today, so you'll probably have to keep a little bit of an eye on the chat for any messages that we share as well. But if you're missing anything, feel free to flag that up and we can continue to share the links as we move through the session. If you have particular questions for the team, please make sure to put those in the Q&A box. As I mentioned, it might get a little bit lost in the chat. So if you make sure to flag any particular questions in the Q&A, that will allow us to track and respond to those directly there as well. Also, if we have lots of questions, it's always useful if you upvote any questions that you think are particularly relevant or interesting for you to make sure that we can prioritize responding to those. But we've got a big panel of individuals helping us today, so I'm sure we'll do our best to get back to all of your questions if we can. So in terms of our format today, we've got a live 3.5 hour session together. We will take a short break in the middle of that as well. Alongside that, there's a homework exercise you can optionally take away, which we'll explain a little bit more about later in the session. As I've already mentioned, there's live Q&A throughout, so we do really encourage you to make use of that opportunity to ask your questions in the Q&A box. We've got a great panel of experts with us here today on hand to answer those, so please don't be shy and make sure to ask your questions. As I've already mentioned, we really love and encourage your participation in this workshop. So we're going to be using a number of interaction tools, including Menti, the polls, as well as the homework. So please do take part in those. And finally, as I think I've seen some questions about already, you are able to receive a CPD certified completion certificate for taking part in today's training. You do need to complete the full live workshop to receive your certificate, and we'll provide some details at the end of the training program about how to receive your certificate then. Okay, so just to introduce who's going to be delivering the training for you today. So as I've mentioned, I'm Fiona, and it's a pleasure to be joined by my colleagues Lois and Danielle, a number of our senior specialists at the SSE who are presenting today too. Also a big thank you to our colleague Tiffany Grabsky, head of the SSE Academy, who's going to be doing her best to answer all of your questions in the background. So thanks for that, Tiffany, as well. We're also joined by our colleagues from the IFRS Foundation. So a big thank you and welcome to Robert and Arturo, who'll be presenting for us today. And they're also joined by their colleagues Visvesh and Rebecca as well, who'll also be available in the background to support with questions. So a big thank you to all of our IFRS colleagues for joining us. So in terms of our learning objectives for today's training, there's three key areas we're looking to help advance. Firstly, we'd like to help you to understand the ISSB standards. Secondly, to understand how you can use the ISSB standards. And finally, to identify the steps that you can take to develop a disclosure plan to apply the ISSB standards. And so how do we break that down? Well, we've developed a 4-module structure for this training program that's really about breaking that into a simple step-by-step approach to aligning with and reporting against the standards. So think about this module structure as we move through the training today, and it'll help you to keep in mind where we're up to with our content. So firstly, we have the prepare module. So that's all around building on any existing knowledge that you might have about the purpose of sustainability reporting, the overall landscape, and how that global baseline of the IFRS S1 and S2 standards has developed. We'll then move into align. So this is all around setting the direction for your reporting, thinking about how you can apply and use those standards and what additional disclosures you may also need to add to reflect the particular requirements that are applicable in your geography, sector, or regulatory context. Then we're going to move into implement. So this is all around your practices and systems. So thinking about how you can go around identifying, evaluating, and integrating different sustainability related risks and opportunities into your organization's strategy and core processes. And then we'll finish off our session together with communicate. So all around the final format for your reporting. We'll think about the location of your disclosures, the timing of them, efficiency when reporting, and how to build user confidence in your reports as well. And so just to show you the agenda for our training session, this is how our time breaks down together. We'll spend a time across the different modules. We'll take a short break in the middle of the session, and we'll wrap up at the end with some time for homework and additional questions. So just to mention a key point as well, all of the resources that we're going to be talking about today, including this slide presentation and the homework handout, can be downloaded from the SSE webpage. I think that link has already been shared a number of times in the chat, and if you check out the Q&A responses as well, you'll see it's been shared there as well. So thanks, Tiffany, for that. But be sure to check out that link, and you'll be able to download this slide handout, and we'll also share the recording of today's training session afterwards there as well. And as I've mentioned, another aspect that you may wish to take away following today's training is our homework assignment, which you can download from that same page under resources. the homework assignment is structured around developing the draft disclosure plan to take forward what you've learned today within your own organization. So we're going to do a number of interactive exercises today that can help you to start to think about that. But if you'd like to really put this into practice in your own organizations, I encourage you to check out that homework to help you with that too. And the final thing I'd just highlight at the outset is the SSE toolkit of resources. So these resources are structured around a lot of the four disclosure units that we'll be talking about today and are designed to really help you to build out your work in these areas. So encourage you to take a look at that toolkit of resources if you'd like more support on particular topics as well. Okay, so I've got a quick question for you now in Menti, but before I do, I'll just mention as well, apologies, I see our colleague Relitsa Germanova from the IFC has also joined us. So Relitsa is the lead for the ESG Disclosure and Transparency Programme, and I'm sure we'll be happy to share some thoughts in the chat and Q&A in response to your questions as well. So thank you, Rally, for joining us too. Brilliant. Thanks. So moving then into Menti, to warm ourselves up and get used to Menti, we've got a couple of quick questions for you. So there's a couple of different ways that you'll be able to join us in Menti. So firstly, there's a link that we'll share with you in the chat just now, and then I'm going to share my screen as well, and that will give you a couple more options. So you have on the side of the screen there, you should be able to see now a QR code. So you can scan that QR code if you'd like to join us in Menti. You can also go to menti.com and enter that code you're seeing at the top of the screen there. And as we said, there will be a link that Lois has shared in the chat as well that you can follow to get into the session. So our first question for you that you're free to start answering now is to share in your own words what you're hoping to get out of today's training. Why have you joined us? Maybe what do you particularly want to learn about today? Okay, I'm seeing some words coming through already. Networking, knowledge, learning, passion, curiosity. What else have we got? Loads of different words. Upskilling, impact, quality. So great, lots of emotive words actually today. So it's always nice to know that we're coming really energized to the training. And let's hope we can keep up that energy and help you to build that knowledge and that learning on this topic, as you've mentioned. So thanks everyone for sharing. And I think that proves many of us are able to access Menti as well. So that's great to see. Okay, our second quick opener question for you is just to get a sense of how comfortable you are already with some of the areas that we're going to be looking to work on today. So you can use that sliding scale you should see now to vote for these different options. So how comfortable would you be currently in explaining to your colleagues what the ISSB is, in using the ISSB standards, and in developing a sustainability reporting strategy? So take a moment and just to let us know where you think you're currently at. Of course, there's no right or wrong answers here. It's just useful for us to get a sense of your current familiarity. And of course, we'll try and aim to improve on that today. So we'll come back to this question at the end of the session as well. Okay, looks like for those who've voted, we're mostly somewhere in the middle to sort of lower end of comfort and perhaps least familiar at the moment with using the standards themselves, which of course is a great reason to join us today. So let's hope we can help improve on that in today's training. But thanks everyone for voting and letting us know. Okay, so let me take us back to the slides now and we'll get started on the first area of our content. So before I do, I have a quick disclaimer that I'll share with you all and give you just a moment to review. And this is really just to be clear about how we're going to be using company reporting examples in today's training. These are here really just to add some color to what we're talking about because we know, of course, a real world example can help us to put into practice what we're discussing. However, any examples that we do share shouldn't be seen as good practice, the best or the right way to approach this. Of course, each company's circumstances are unique, so you need to approach this in the way that is right for your organizations. But of course, we want to share a few ideas just to give you a little bit of inspiration. Okay, with that disclaimer clarified, let's jump in then, and I'll kick us off with the first module. And as we've said, this is really around building that solid foundation of knowledge. So you probably know more than you already think about the ISSB standards because they build on a lot of the existing frameworks that have been around in the ESG landscape for some time. So in this first unit, to build that solid foundation, we like to cover three different aspects. So firstly, we start with purpose, so thinking about the case for sustainability reporting and what some of the market and business drivers may be. Then we move into landscape, so thinking about how that reporting landscape has evolved and how it's started to become simplified. And then finally, the global baseline. So that's introducing the core concepts and requirements in IFRS S1 and S2 that are providing us with that baseline. But to get us started then on purpose, we're going to look at why. So what is the case? What are the particular drivers that might be existing for organizations to disclose on sustainability? So to get us going with that, I think it'd be useful to firstly get a sense of what your drivers are before we discuss some of the broader ones that might exist. So I've just launched a poll question, which hopefully will be visible for you now, which is asking about your reasons for disclosing or maybe joining us today to learn more about disclosing sustainability related information. So there's regulatory requirements, sharing your own organization's objectives, maybe peer pressure or wanting to match up to what the expectations are from your competitors. Maybe you've had questions from investors. Maybe you have other reasons as well, or maybe you're not yet disclosing. So feel free to share any other thoughts in the chat of any reasons you might have. And if you are having any issues accessing the poll, you can also share your responses with us there as well. But I see lots of you have voted already, which is great to see. So let's keep up that participation in the polls throughout the session. But in the interest of time, I'll close that there. I see more than half of you have been able to take part, and I'll share the results. So it looks like the top reason for most attendees is regulatory requirements. And then the next most common answer being that investor interest. I think that is quite a common picture that we're seeing globally now, and obviously demonstrating that move from a perhaps voluntary landscape of reporting towards these new mandatory requirements. So thanks for sharing, everyone there. So let's have a little bit of a look now at some of these drivers together. Well, I know quite a few of you there highlighted that investor interest in this topic was something driving your reporting. And this is definitely a picture that we're seeing to be the case globally. So the data we're showing you here is the number of signatories to the Principles for Responsible Investment, which is now more than 5,000 globally, representing more than 128 trillion US dollars in assets under management. So what is it that's really driven that increase in interest from the investor community over recent years? Well, I think what we'd like to highlight here is that a key driver behind this demand is the potential financial effects of sustainability related issues and the real growing recognition that for companies, this is a highly relevant factor to long-term value creation and strategic resilience. And so the data we're showing here is from a recent study of institutional investors, which was conducted by HSBC. And they found that the top driver for investors to incorporate climate change and environmental issues into their investment strategies was the perceived impact of these factors on long-term performance. And so you can take a closer look at this study if you follow the link in the handout. But before we move on, we're going to talk a little bit more about what we might mean there by financial performance. So a couple of key definitions I think it's important to keep in mind. Firstly, we need to remember today that what we're talking about is disclosing financially material sustainability related information. And so we'll talk a bit later about materiality, but let's be clear from the start about the types of financial effects that we're looking to provide more information to our investors on. So starting with effects on a company's financial performance, we often see this reflected in the profit and loss statement, which will show our income and revenue and expenditure. And so sustainability related risks and opportunities can have a financial effect by either changing the revenue mix or total revenue of a company. For example, if demands for its products and services change, or maybe its production capacity might just be disrupted. But we could also see changes in expenditures. So, for example, operating costs could increase due to energy prices, or maybe there's a need for greater R&D investment to capitalize on a particular sustainability related opportunity. So that's just a few examples there. And so you'll also hear us talking today about effects on a company's financial position. So let's also see what we mean by that. And so we often see a company's financial position on their balance sheet, known as the statement of financial position. So, for example, a company might experience changes to certain assets or liabilities due to climate issues. We might see changes to portfolio value, or we could even see write-offs of certain assets that are damaged or perhaps need to be repriced as a result of sustainability issues. And another financial effect we could see is changes to financing and the cost of capital. So, for example, this could include revisions to equity valuations as a result of climate risks, and also making use of new financial structures such as green bonds, social bonds as well. So just to close out this unit, we have a couple of important aspects about sustainability-related risks and opportunities, which we'd like to highlight because they're quite essential to our understanding of this topic and how we approach disclosure on them. So before we jump in, it's worth noting that the ISSB standards are designed to help a company identify and communicate its own specific sustainability-related risks and opportunities. But we'll look for a moment at the global picture to help us understand this point. So firstly, you can see here from the latest Global Risk Perception Survey conducted by the World Economic Forum that risks evolve over time. So something that might pose a significant risk perhaps 10 years from now might not be a topic that's front of mind today. So what's important for our disclosures is that we're preparing for those risks that we're expecting to arrive perhaps 5 or 10 years from now. And that if we're taking that preparatory action, there may be impacts then that we need to disclose today. For example, we may need to invest in new practices or processes to mitigate a risk or realize an opportunity as well. And so what that means is that those financial effects that we just talked about could actually happen much sooner than the time horizon of the risk itself. And a final important aspect to highlight about sustainability-related risks and opportunities is their interconnectivity. And so another visual here from the WEF report really shows how interconnected different risk types are between environment, social, geopolitical, etc. So while many people might think of the two ISSB standards as separate standards, one for climate and one for other sustainability topics, what we can see here is that, of course, many of these issues are very much interconnected. And so what's important is that we consider the whole when we're making strategic decisions. And in fact, in S1, the IFRS S1 standard, on the conceptual foundation side, there are requirements related to connected information. And so this is all about getting a holistic picture for investors of the different risks and opportunities that affect the organization. Okay, so with that, I'll hand over to Lois now, who'll take us through our next unit.
Thank you, Fiona, and hello, everybody. So Fiona's taken us through a talk about why the standards are important because of the interest of investors and because of the risk that sustainability presents. So now we're going to look at how the IFRS sustainability disclosure standards developed within the landscape of existing reporting standards. But before we do that, can we ask you via Zoom, please, which standards are you currently using? Which standards or frameworks? Are you already using IFRS S1 and or S2? Do you use the Global Reporting Initiative standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosures, regional standards such as the European Sustainability Reporting Standards or others? And if there are others, could you tell us in the chat? Thank you. We're already seeing some responses coming through in the chat of people using BISR and GRI. I suspect some of you are using more than one of these standards as well, as you're indicating in the chat. Some people using GRI, ISSB and TCFD. Some people relying on their national standards. So, in the interest of time, and now we have more than half of you participating, let's end the poll and share the results. And as you can see, there's quite a mix here. The majority, 58%, using GRI. But now, next we have people using IFRS S1 and S2 that we'll be talking about today, and also ISSB and TCFD, which, as we'll see in a moment, have been incorporated into the ISSB standards. So thank you for sharing that and letting us know the range of frameworks and standards you're currently using. Let's go on, though, to look at the structure of the IFRS Foundation, which is the organization that has developed the standards we're talking about today. The IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, you'll see that within the foundation, there are two independent standard setting boards. The International Accounting Standards Board, formed in 2001, issues financial accounting standards, which are in place in over 140 jurisdictions around the world. And the sister organization we're talking about today, the International Sustainability Standards Board, formed in 2021, released IFRS S1 and S2 in 2023, following strong market demand for its establishment. Now, because both of these boards sit within the foundation, they're able to work closely together to ensure that financial and sustainability standards complement each other. Governance of these standard setting boards is provided by IFRS Foundation trustees, and they are in turn accountable to a monitoring board of public authorities. So how did these standards come to be? Well, we've already heard from you that you're using the standards, many of the standards whose logo you see on this screen, and all of them have contributed to the evolution of sustainability reporting. They actually have much in common, but sometimes their objective, scope, guidelines, and definitions can differ for legitimate reasons, but it has caused some confusion. The one thing that you can take from this slide, though, is that this is a picture of harmonization and standardization. So you can see from the arrows that point towards IFRS sustainability that much of the work of the organizations shown by the logos has been consolidated into or aligned with the IFRS sustainability standards. So just to talk you through these, the Transition Plan Task Force work, the Task Force on Climate-Related Financial Disclosures, the three organisations at the bottom of the slide, CDSB, the Integrated Reporting Framework, and ISSB, all of their work is now the responsibility of and or has been consolidated into the ISSB standards. CDP has aligned its climate questionnaire with IFRS S2 climate requirements, and the GRI and the IFRS Foundation work very closely together to ensure that the reporting landscape is as simplified and harmonized as possible. And we'll talk more about that a bit later. So let's ask you this question now. We've seen that there's a picture of consolidation emerging, but there is still some differences between reporting standards and frameworks, and I'm sure those of you that use many of them will know this. So what do you think the reasons for this are? You can select as many as apply, so you can select all of them if you think they're all appropriate, and if there's another reason you think about might apply, tell us in the chat. Great to see so many of you responding. Thank you. Just for the interests of time, and because I can see that I think you know the answer to this, I'm going to share the results. Yes, as you've indicated, all of these apply. There are differences because of different reporting objectives, different scope, definitions, wording, and materiality focus. And actually, a good example to illustrate those differences is by explaining what happened when the TCFD's work was taken over by the IFRS Foundation in July 2023. All of the TCFD's recommendations are now incorporated into IFRS S2, but there are some differences, which I can summarize by saying, one, there are differences in wording, but the wording captures the same information, it's just language preference. Secondly, S2 requires more detailed information than the TCFD did. So, for example, this might include more information about how carbon credits are used to satisfy GHG emission reduction targets. And finally, S2 requires some additional information and has some additional guidance, in particular on sector specific information for sustainability, which we will look at later. Now, the ISSB's main objective when it started its work was to develop standards that would provide a common language and a global baseline for sustainability-related financial information. And this was to enable comparable and consistent sustainability disclosures across global capital markets. And the Foundation is working with jurisdictions around the world, as well as with other stakeholders, to achieve this. Now, the standards and the ISSB recognize that in addition to what the standards say, there may be jurisdictional and other specific requirements that apply at local level or at sector level, for example, or at country level. So the global baseline allows additional requirements to be added in certain jurisdictions and for certain purposes, which we call building blocks. So building blocks can be added to the global baseline to represent a full set of disclosures. And those building blocks go beyond the remit of the ISSB and might include the type of disclosures that are requested by the GRI standards for a wider stakeholder audience than just investors. So this building block approach reduces the need to duplicate information by having this globally consistent baseline of disclosures, whilst allowing additional information to be reported based on standards like the GRI standards. Now, just to say briefly, there's been global backing for this approach reflected in the ISSB standards. The International Organization of Securities Commissions has endorsed the standards and asked their 130 members around the world to consider how they can incorporate the standards into their regulatory frameworks. The International Auditing and Assurance Standards Board has issued an assurance standard, ISSA 5000, to complement the disclosure standards and allow for assurance of information. As we said before, ISSB is working with jurisdictions around the world to support them with planning and preparation for voluntary or mandatory adoption of the standards. And of course, the Foundation is working with many other market participants, such as through this training session today, to educate and encourage adoption of the standards. So with that, I'm going to hand over to our colleague Robert from the IFRS Foundation to start explaining the standards to us.
Great. Yes, indeed. Thank you very much, Lois. Yeah, we're moving to the next section of this module. We're talking about the baseline. So far, we talk about the business case and the market case for sustainability reporting, the evolution of the landscape and how it's being simplified and rationalized. So now let's introduce S1 and S2 standards. So there are a few important terms I'd like to start with, and that need to remember that this should be understood in order to follow this course. So you can find the definitions in your handout, but I wanted to briefly mention them here as well. So first of all, we'll be saying the phrase sustainability related financial information quite a lot. This can be information about the broad set of issues, including climate, nature, biodiversity, human or social matters. And then, so sustainability related financial information is information about companies' sustainability related risks and opportunities that is useful to investors in making decisions about providing resources to a company. What does it mean? So these are the sustainability related risks and opportunities are those that could be reasonably expected to affect companies' cash flows, access to finance, or cost of capital. So that these are the ones which could affect the company's prospects. We'll then also refer to general purpose financial reports, which include the company's financial statements and management commentary. You might know this as a management report, management review, management discussion and analysis, or strategic report. Some regulators require specific disclosure in certain parts of general purpose financial reports, so we use this generic phrase throughout. So here we have just summarized key points on each term, but you can also refer to S1 for fuller definitions for each of these phrases. All right, and as we already indicated, as the S1 and S2 are from TCFD logic, and so anyone familiar with TCFD will recognize the same four core pillars or content areas for the ISSB standards. They are governance strategy, risk management, and metrics and targets. For each content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of four content areas in detail today, and I encourage you to download the standards as a part of your homework assignment. All right, so that's a quick overview of the key content areas. Let's now move on to introducing standards. So, to start with, IFRS S1. I would say to all preparers listening today, let me start by saying don't be afraid. Yes, that's a lot to understand and consume, but you might be surprised at some of the details you're already familiar with. And to all the accountants listening, you also will be relieved to see that many of the conceptual foundations developed by the IASB, by the accounting body, are also in the ISSB standards. So IFRS S1, or as its full name, it's General Requirements for Disclosure of Sustainability-Related Financial Information. So as the title suggests, IFRS 1 sets out general requirements for the content and presentation of material information about sustainability-related financial opportunities. If you're familiar with TCFD, you also see the same architecture applied through all the standards. And for matters ordinary and climate, S1 asks preparers to refer and consider the applicability of the ISSB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information about them as well. The ISSB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements, any national accounting requirements that you may be required to follow. All right, so that's the quick introduction to IFRS S1 and what it's about. Let's now move on to IFRS S2. So as we mentioned, the scope of S1 is all sustainability-related risks and opportunities. There's S2 focuses on climate disclosures, building on the same foundations of S1. So for example, it fully incorporates the recommendation of TCFD. It sets all the requirements for a company to disclose material information about its climate-related risks and opportunities, and it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risks, which we'll come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and greenhouse gas emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2, such as ISSB standards. And these, again, are organized by industry, enabling a company to identify climate-related disclosures that are applicable to its business model and operation. Okay, we saw the two standards, and now let's see and find out how they relate with each other. So it's important to note here that these are not standalone standards. They're a package and they must be applied together. Even when a company is reporting the climate-related risks and opportunities, the company must apply both standards S1 and S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. IFRS S1 it also explains the concept of materiality and how companies identify material sustainability-related financial information. Now let's move to conceptual foundation, important topic in order to understand the logic and say philosophy behind the standards and how they underpin the standard setting here. So this might be new to anybody without accounting background, but those who are familiar with accounting, they'll find those terms familiar. So these concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. So to start with, companies must thoroughly present a complete set of sustainability-related opportunities. A fair presentation also requires disclosures to be faithfully represented. So to achieve these, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity, another term here, concept, requires the organization boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is the connected information. So we saw earlier when Fiona was presenting and how it was explained how different risks and are often interconnected with each other. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between disclosures in 4 content areas we talk about, and between sustainability-related financial disclosures and financial statements. How this connectivity can work in practice and how it can be achieved in the disclosures. We have an example here, and Lois will present it to you. Over to you, Lois.
Thank you, Robert. And as this is our very first example of the training today, I just want to remind everybody of the disclaimer that Fiona gave earlier, that we present these examples to you for inspiration and information rather than as best practice examples. And they're all extracts, so they need to be understood in the context of a wider report, ideally. But we're using this example from BHP, which is a metal and mining company, to illustrate the concept of connectivity. So this is an extract from the company's operating and financial review section of their annual report, and it is part of the disclosure about how the company manages climate-related risks and plans to transition to a net zero economy. So the first paragraph tells us that climate risk assessments and climate scenario analysis are integrated into and therefore connected with the company's strategy, and also that those climate risk assessments and scenario analyses are treated as a sensitivity in their capital allocation process. So you can see there this connection and alignment between the company's capital allocation plans and their understanding of risks and risks under different scenarios, and their understanding of the rapidly decarbonising global economy. Second thing they tell us is that they've got some studies that are still in progress, in particular assessing the effect of future physical climate-related risks on the company's operations, productivities and costs. But you can see from that statement that they are going to use the information to inform updates to their risk profile and their risk management activities and their corporate planning. So again, the understanding of physical climate risk is not detached from, but is incorporated and connected with other business activities. Final thing to say about this example is that in the pale grey text at the bottom of the extract, we get links and connections to where we can find further information about the statements made about the impact on the business strategy and capital allocation of climate risk. Back to you now, Robert.
Great. Thank you very much, Lois. Right, connectivity. Before we move on, we're gonna have another question on this topic. So let's try and check your understanding on the term of connected information. So for that, we have another Zoom poll. The question is, what information should be considered for connected information? And we have three options here. Option A, I know whether it should be connection between governance, strategy, risk management, and metrics and targets. So the key four pillars. Or whether it should be B, between the sustainability-related financial disclosures and financial statements, or whether it should be C, between sustainability-related risks and opportunities. Please do select all which apply here. So I don't see the poll coming up, so I hope that you can see it. I'll give you a moment to answer this question. Right, I hope you had a chance to answer this question in the Zoom poll. I don't have it. Oh, yeah, I see it on my screen. Perfect. All right, great. Yeah, most of you answered correctly. I mean, the ones who answered A, B, and C. That's the right answer here. So the connectivity and connected information, it is between all these different elements listed in this question and in the answers. So A, B, and C are all correct answers, and the connection should be achieved between all these elements. All right, thank you very much for taking part in the Zoom poll. We're then moving to the next important term, materiality. So the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going into this in more detail later on, but just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. Right, and then we will be talking now about some additional guidance, which was and necessary to also to apply and to think about when disclosing in accordance with the ISSB standards. So during the ISSB consultation on the exposure drafts, one of the key feedback topics was that the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. So in addition to standards and in addition to the standards and application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The ISSB standards were also used to create the industry-based guidance accompanying S2. Finally, the FSA credential was also updated with more planned to come. I should also note that the IFRS Foundation Capacity Building Program, launched at COP27, is a key part of our support to preparers, and the SSC training we're currently having initiative is one of our most important deliverables. All right, and we will have another Zoom poll. So we will now have that's a quick pause with the Zoom poll, and this one is designed to test a really important principle in IFRS S1 and S2. So it's you see the questions about water. So even where the ISSB has not yet issued a topic standard on water, there is a good example that this does not mean that companies ignore this issue as long as it's material. So instead, the standards explicitly allow and expect companies to look to other relevant sources of guidance. But just sorry, I'm just maybe helping you to answer these questions, but please do have a look and answer yourself. So what would be the right course of action here in case water is a material element in your company? So yeah, there'll be an option to do not disclose anything about it. There will be option to consult the sources of guidance listed by ISSB, or engage a consultancy to help, or copy your competitors' reporting. And I can see already that most of you answered it correctly. That is to consult the sources of guidance listed by ISSB. You may also think about engaging a consultancy to help. That's perfectly fine, and might be encouraged even. But you should not copy your competitors' reporting, and also do not disclosing anything about the water is not an option here. As long as the water is a material topic in your organization, you should disclose this information using their applicable sources of guidance. All right, and with this Zoom poll, I'll be handing over to Fiona, who will provide a summary of the module 1. Over to you, Fiona.
Great, thank you so much for that, Robert, and to Lois as well. So, as we said, that brings us now to the end of our first module. So let's take a few moments together to recap on what we've covered so far. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we're hoping that you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. So if you're not aiming to make good use of the data that you're collecting to improve your own strategic decision-making, you're going about this wrong and you're wasting an opportunity. Additionally, if you have operations in difficult to abate or high impact sectors, it could be that your competitors are already disclosing risks and identifying opportunities they're pursuing. And that will then leave your investors wondering why you're lagging behind, and that could affect your equity evaluation and your ability to access capital. And then next, we looked at the evolution of disclosure standards, the formation of the ISSB, and that aim to simplify the landscape. So when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather that they build on top of them. And then finally there, we introduced the standards and the important concepts that you need to understand in order to use them correctly. And a key point I want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors. And so they're heavily focused on those prospects that we talked about at the very start of the unit, relating to effects on financial performance and position. Okay, so to get you all thinking about this, we're now going to wrap up the module with a quick exercise. So I'll introduce this firstly. So we think an important part of this disclosure plan that we'd encourage you to develop through the homework is to be clear about the objectives for your sustainability disclosures. And so I think it's an important thing to discuss with your colleagues and to document at the outset. And so here we're thinking about setting goals. So being clear on what you're trying to achieve with your disclosures or any adaptations to them you're making. To think about the requirements, so thinking about the particular reporting requirements you're seeking to meet, maybe the needs of your jurisdictions or your investors. And finally, when you're thinking about these goals, you'll also want to consider the reality of where you're at today. So what is it that you need to update in your disclosures, and possibly your goal needs to be quite grand in terms of getting from a very low disclosure point to a higher one, but maybe actually it's a little bit more incremental if you already have some practices in place. So we'd like to give you a moment just to reflect from what you've heard so far and what you know of what your own organization's approach is on what your objectives are with sustainability disclosure. And if you're maybe an advisor or working alongside companies, you could think here about how you aim to support them, or you could think about a particular company that you're working with. So I'll just ask my colleagues to reshare the Menti link a few times. I know it can be easy to lose in the chat there, and then I'll reshare my screen as well. Great. See a number of you already responding there, so that's great to see. And as a reminder, you can go to menti.com and enter that code on the top of the screen, or Lois has just reshared the link to join us directly as well. Let's give some of you a little moment to have a think in the background, but we'll have a look together at those responses we've had so far about what you think your objectives are from sustainability disclosure for your organizations. So someone's mentioned maybe more investments on strategy, guiding, and compliance. Okay. Another person here mentioning investors. So thinking about providing your investors with the most accurate possible information concerning risks and opportunities on climate. Okay, very good. Someone here is mentioned, so reporting on sustainability and financial information according to the regulations and importantly, to industry standards. So yeah, thinking about that aspect as well and what's applicable in your given industry. And I think another really important aspect you highlight there is that this is about sustainability and finance and the interconnection between the two. So a good thing to also keep in mind is that interconnectivity we've already talked about. So I see fair representation or presentation mentioned, of course, compliance. I know many of you mentioned that regulation was a key driver here. So of course, a simple goal from your disclosures will be to meet regulatory requirements. And clearly that's an important starting point. But I think what we're really encouraging you to think about here as well is how you can really make the most of your disclosure efforts. So of course, compliance is important and critical. But if we're not aiming to go a little bit beyond that and think about how we can really use this information to drive our own decision making, our own risk management, and capitalizing on opportunities, we are missing a bit of an opportunity to use this information for good purposes too. So we're here seeing as well around stakeholder perceptions and greater transparency. And maybe people have also mentioned around capital to support the transition. So that's a good point to highlight too. Increasingly investors are looking to company disclosures to help them understand, what the transition risks given organizations are exposed to, how it is that they're incorporating those issues into their long-term strategies to help them understand, which companies ultimately are taking that action they need to transition to a lower carbon future. So that's something we'll come on to a little bit later, but I think a great point to highlight that disclosure can play an important part in helping to access the capital needed to finance the transition. Great. So what else do we see here? So supporting companies with their sustainability goals. Yeah, that's a good point to highlight here as well, that disclosure is not just about that outward view to stakeholders, but also that constant check that you have of, are you meeting the objectives that you've set for your own organization internally too? So yeah, having a structured strategy and way of monitoring your progress using metrics and targets will help you to see if you're aligned with the goals that you've set for your organization too. Lovely. Thanks for all of these great responses. So I see several people mentioning similar themes. Let's have a little bit of a look and see if anything jumps out. Someone's mentioned here around education and board engagement as well. So I think another great point to highlight. Of course, it's critical that the board are playing a role in informing the assessment, the strategy around sustainability related risks and opportunities, and that they have the skills to scrutinize disclosures. If that's a topic you're interested in, we'll be piloting and launching a board specific version of this training later in the year. So do keep an eye out for that. Lovely. Let's have a little flick. We're seeing loads of great answers here. See, so regulatory requirements. So someone's also mentioned the BRSR, which I believe is in India. So I think that's another good point to highlight, of course, that jurisdictions are already starting to adopt requirements that build on these disclosures. So of course, important to look both at the standards and the guidance themselves, but also those regulatory adoptions and how those have been implemented as well. Lovely. So what else do we see here? Market development. So that's a good point as well. So thinking about maybe the opportunities that you have for your business as a result of identifying sustainability related opportunities, being seen to manage risks effectively, maybe there's a competitive advantage there too. So I think lots of you have really got the message we were hoping for here, which of course that there's a lot that you can achieve through sustainability disclosure beyond compliance. And so being clear with that outset and setting those objectives, agreeing those with your colleagues is a great basis for a solid approach to disclosure. So I think we'd encourage you to really think about that audience and any stakeholder feedback you've had that can help you to inform these objectives, and really make sure that you're looking to the future here as well. So not just meeting the requirements that are in place now, but thinking in a forward approach to how will you be adaptive and flexible to future requirements too. Great, thank you everyone for those brilliant inputs to that exercise. So we're going to be starting now on our second module, which I'll hand back over to Robert to get us started on.
Perfect. Thank you, Fiona. Yes, let's then move on to the next module of this course, and it's the next module is align. So now that we have introduced the initial concepts, let's dive how to apply the ISSB standards, taking into account additional disclosures requirements, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership objectives. So breaking the unit down, in order to understand how to ensure how disclosures meet global standards, we'll look at two concepts in this unit. The first and the main focus of the unit will be how to apply the standards as a global baseline for sustainability-related financial disclosures for capital markets. And once we cover that, we also discuss how additional disclosures fit. To begin with, let's focus on how to apply ISSB standards as a global baseline. So we will now go through the core content areas. We'll start with the governance, and this include aspects that relate to the governance body in your company and how management is applied. So for each core content area, we'll discuss questions that you could ask in your company to start to identify the information that will support some of the disclosure requirements, for example, as a part of gap analysis. So as we look at the governance and management requirements, we can see that there are several matters, fairly qualitative questions and matters you might want to consider. So for example, the question will be which bodies are responsible for the oversight and management of processes, controls, and procedures of sustainability-related risks and opportunities. So, for example, is management responsibility delegated to a specific body or committee? Then another question would be how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. And this could include setting targets to manage sustainability-related risks and opportunities. And then finally, there will be a question worth to ask whether progress against these targets is linked to executive remuneration. So for more information, you can make use of the SSE checklist tool, but do remember that it's not a replacement for reading and using full ISSB standards. So to show how this can be applied in practice, we'll have examples, and I think not one, but even two, and Lois will present them to you right now. Over to you, Lois.
Thanks, Robert. Yes, we've got two examples coming up now to illustrate governance disclosures. The first is from a company called Yara, which is a global crop nutrition company, 17,000 employees in 60 countries. And what we see here is a highly integrated governance model. Now, this extract is from the sustainability statements within the 2024 integrated report. The dark brown boxes you can see right in the middle show the board of directors and president and CEO. So these are the primary governance bodies. And what we see in this extract is how they are supported by different committees and other bodies in relation to sustainability activity. So on the far left at the top, we see the Board Audit and Sustainability Committee. That assists the Board of Directors in overseeing the process for and internal control of sustainability, reporting and material impacts, risks and opportunities. Then below in the light green boxes, we see the Sustainability Governance Team. Now they have a direct reporting line to the Chief Financial Officer, and they're responsible for sustainability performance and reporting. And their work is closely aligned with the corporate performance and risk functions. Then right at the bottom in the pale brown box, we see the Sustainability Network, and that reviews Yara's accountability processes and systems in place for ESG policies, and they monitor sustainability performance. Now you can see that there's sustainability responsibility operates across many other functions in this organization, including ethics and compliance, corporate affairs, and so on. We have the arrows showing us the reporting line. We just talked about the sustainability governance team reporting to the CFO. The arrows also indicate how we have cross-cutting input to activities from the sustainability network and other bodies, and arrows are used to indicate the flow of information and input between governance models. Now, I should stress that the ISSB standards don't require a particular type of governance model. That will depend on the company's needs, what's fit for their purpose, but also to be determined in the context of their particular legal environment. Now let's look at another example now, and this is from the integrated report of Petronas 2024. Petronas is Malaysia's national oil and gas company and a global energy group with presence in over 100 countries. And in this example, the governance structure shows the executive, non-executive and independent roles of the board of directors in that top line under the title Board of Directors. Then below that, there are 3 committees to which the board delegates authority, responsibility and operations. Now, it's quite a lot to read here, and all I wanted to point out to you here is that all 3 of these board committees have some responsibility for climate. The audit committee monitors climate-related reporting and actually provides internal insurance on greenhouse gas emissions. The nomination and remuneration committee reviews the president and group CEO's performance scorecard, and that includes climate-related measures. And the risk committee work, of course, also includes looking at climate-related risks and mitigations. And right at the bottom of the screen, you can see the executive leadership teams. Duties also include sustainability, and they report up to the committees and up to the board. So again, what we see here is responsibility for sustainability split across multiple different functions and committees, all reporting to the board of directors in an integrated structure. So I'm now going to hand over to Danielle, who's going to take us through the strategy part of the requirements. Over to you, Danielle.
Thank you so much, Lois. So great. Now, with those examples, hopefully making governance fairly clear, let's look at the next core content area, which is strategy. So strategy has quite a few more discussions to include, but it's really where companies can see the benefits from sustainability-related opportunities and being prepared for the risks. As you can see here, there are 3 high-level areas that we will focus on in the strategy content areas, which are the risks and opportunities, the effects, and resilience. And we will review each of these separately. So for the strategy 1, so for IFRS S1 and S2, disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability risks and opportunities. If we first look at the requirements related to sustainability risks and opportunities, there are some questions you'll want to be asking internally. When disclosing information about risks, information required includes the description of the effects, the time horizons under which those effects are expected, keeping in mind that the financial effects can occur before the risk or opportunity materializes and/or after and can change over time. The last two questions on the list, in particular, look at climate. So this aligns with the requirements for S2. So, for example, investors also want to understand what types of risks or opportunities, and S2 requires companies to identify climate-related risks under the categories from the TCFD, physical and transition risks. Both standards include guidance and support companies as they identify and disclose material information about risks and opportunities. For example, using the industry-based guidance and ISSB standards. This can often be easier to understand with an example, so let's add some color here of what this might look like in practice. And I will just get this slide up. So here we have Mondi. This is their 2024 integrated report. So Mondi Group, for those not aware, is a multinational packaging and paper group with operations across Europe, North America, and Africa. In the left hand, you can see which risks the company has identified and how the risks align with four key categories. So strategic, financial, operational, and compliance. And the delegated risk owners. There's a lot more information about the risk throughout their report. Climate change risk is the strategic categories are then further analyzed in the second extract you can see here and are categorized as physical and transition risks as well as opportunities. There are also identified the risks through the evaluation process described in the report. Mondi shows estimated financial impact ranges, time horizons, which include the difference between the onset and full impacts of the risks and opportunities, and the sensitivity of the risks and opportunities in terms of likelihood under different temperature scenarios. So now looking at time horizons, this is another aspect of the risk and opportunities identified as potentially affecting companies' prospects that will need to be disclosed. And it brings us back to what was discussed at the beginning, time. You may remember we discussed earlier that the time factor is something quite different when we're talking about sustainability-related disclosures. So let's make sure we're clear on what we mean by time horizons. The standards ask you to identify within what time horizon over which the effect of each of those sustainability-related risks and opportunities could be reasonably expected to occur. Definitions of short, medium, and long-term time horizons can vary between companies and depend on many different factors. They can depend on things like investment and business cycle, strategic planning horizons, life of assessments, and other factors. What's important to remember is that this time horizon should be defined. So don't expect investors to know what short and medium term means. Provide a quantitative definition. Apologies. Okay, so here we have some questions to evaluate. So we're going to move on now to the second grouping of disclosures in the strategy category. The first section of the strategy component relates to identifying the risks and opportunities that could be reasonably expected to affect the company's prospects. The next set of disclosure requirements focus on what exactly the effect is and where it occurs in the business. To start tackling the disclosure requirements of the standard, companies might want to start asking themselves questions such as beginning to describe these effects and understanding the response planned for mitigating or adapting to the effects identified from sustainability-related risks and opportunities. Again, an example can help bring some color, so let's look at one now. So this is from BASF from their 2024 annual report. So here you can see it illustrates some of the projects that form part of the company's sustainability strategy called Winning Ways. The strategy includes supplying customers with products that contribute to sustainability through the use of their reduced carbon footprint. The company's prioritizing projects where they see rising demand from customers and a willingness to pay for more sustainable products, as well as transformation projects that support the company's license to operate. Among other things, the company is investing in renewable energies to operate their plants. You can see that in the own production panel in this extract. The triple S reference in the last panel refers to sustainable solution steering to streamline the company's portfolio and support their global sustainability-related targets. In related commentary, the company says that it wants to achieve 10 billion euros in sales revenue by 2030 from products that contribute to the transition to a circular economy. The example illustrates how the company's sustainability strategy affects the business model and value chain. Connections are made between the company's strategy, sustainability targets, technology, ambitions, the value chain, and financial estimates. So here we see sometimes one of the obstacles companies face when reporting on these effects, however, is to what detail this information should be disclosed. In the example we just looked at, we were showing mostly qualitative disclosures and descriptions. But what about quantitative disclosures? A company is required to disclose both quantitative and qualitative information about the current and anticipated financial effects of a sustainability-related risk or opportunity. However, the standard also set out criteria for when only qualitative information is required. Using only qualitative information for current and anticipated financial effects is permitted if a company cannot separate the effects of a sustainability-related risk or opportunity from other effects, or if there is a high level of measurement uncertainty. Additionally, only qualitative information for anticipated financial effects is permitted if the company does not have the skills, capabilities, or resources to provide that quantitative information. And so here is an example that you can take a look at that will be available to download. And then we're coming now to the last part of the strategy component. The first part was looking at the risks and opportunities that could reasonably be expected to affect the reporting company. The second, at what the effect is. And now this group of disclosures looks particularly at how the company is prepared for uncertainties and ensuring its resilience into the future. This really gets into the practice and process that a company has in place to assess its own resilience and to make strategic adjustments when needed. Disclosures include information on how the assessment was carried out and its time horizons. For climate-related development uncertainties, S2 additionally requires the use of climate-related scenario analysis, so using an approach commensurate with the company's circumstances. Required disclosures include, first, its assessment of climate resilience, and two, the inputs and key assumptions used in the scenario analysis. We'll dive deeper into scenario analysis in a moment, but some questions you can consider asking internally when starting to disclose this information. Focus on the company's capacity to react or adjust to the uncertainties arising and how different scenarios are being used to test this resilience. Now, let's look at a couple examples of how this is being disclosed in practice. Okay, so here we have an example from Stora Enso, which is a Finnish and Swedish forestry product company. It shows us in this small diagram on the top right side what sales are likely to look like in 2030. They distinguish between essential and business growth in the small yet powerful infographic. We don't have any numbers here, but we have an immediate picture of where growth is anticipated and also detail about the company's long-term vision and their recent transition, which they describe as proactively repositioning the business from largely a pulp and paper company to a renewable materials company, ensuring our future for many more years to come. They give a sense of how the growth business will expand through acquisition of other companies, converting machines, and through innovation. And our next example we'll look at will be Marks and Spencer. So here you can see this British multinational retailer, and this comes from their disclosures about the impacts of climate-related risks and opportunities on the company's business, strategy, and financial planning. It gives a lot of information about the risks and opportunities that respond to ISSB requirements. The first column describes the risk or opportunity. The first is a transition risk and is about new environmental compliance. The second row is both a transition risk and an opportunity and is about the company's ability to keep pace with customer trends and preferences for more sustainable product choices. The next column then explains which part of the businesses are affected by the risk or opportunity. The third column shows whether the risk or opportunity manifests over the near, medium, or long term. The fourth column, the report describes the potential financial impact on the business. Note the little Q on the first line, which means that the company has been able to quantify the risk. The little n on the second line means that the company has not been able to quantify the risk. The disclosure tells us what type of financial impact they anticipate. For example, changes in operating costs, in capital expenditure, or in revenue. There's also a reference to where further information about the capital expenditure costs for risks can be found in the financial statement. In the final column, the disclosure gives details of the business response to the risk, such as reviewing shoppers' sustainability preferences, investing in innovation, and new product development, as well as the targets related to the risks. For example, in response to the second risk, that by the end of 25-26, 100% of polyester used in fashion, home, and beauty products will come from more sustainable sources. And now we have a Zoom poll. So here you guys can see if you want to select the appropriate answers, it should have popped up. So the company may choose to disclose only qualitative information and/or combined quantitative information about current and anticipated financial effects when, and then please select all that you think apply. And it'd be great. We're slowly getting some clicks. It'd be great if we could get close to 50% participation, so we'll give it a minute. But thank you all very much. So again, select all that you think apply. We're at a little past 30%, so we'll give it another maybe minute. This is great. All right, we're getting close. So I'm going to go ahead and end the poll now, last chance. There we go. So yes, you can see pretty much everyone got it right. The answers here are A and B. As we covered, both are the criteria set out in standards for when only qualitative or a mix of qualitative and quantitative information is permitted. However, option C is incorrect because, of course, it's important that our disclosures are balanced. So if we do have quantitative information about possible material negative financial effects, it's important that we provide this transparency to the investors. And indeed, we saw that was the case in the disclosure examples we've just discussed, where the companies are disclosing financial effects for both risks and opportunities. Now, I'll pass this back to Lois to look at some of the climate-specific aspects of this content area.
Thanks very much for taking us through that, Danielle. So when disclosing information related to strategy, There are some additional requirements in S2. We look at governance across the governance requirements across S1 and S2. They're very similar, but with strategy, the strategy component, we see additional requirements that are climate specific in S2. So we're going to go through those now. So the climate-specific strategy points in IFRS S2 require companies to refer to and consider the applicability of industry-based disclosure topics. Now there is you'll find available on the ISSB website some guidance on these industry-based topics, the industry-based metrics and topics. So, for example, if you were in the personal products industry, you might find that you would be asked to make disclosures about the extent to which the products the supplies you buy are from certified sources, things like that. In addition, S2 requires a company to provide detailed information on where in the business model and value chain risks and opportunities are concentrated. So are there assets particularly at risk from physical climate risk, for example? The company is asked to provide information on the effects of climate-related risks and opportunities, and in particular, how they respond to those effects. For example, through a transition plan or through the setting of targets. We're going to talk about transition plans in a moment. In providing disclosures about the current and anticipated effects of risks and opportunities on the company's financial position, performance, and cash flow, S2 sets out criteria for when quantitative and qualitative information is required. And in particular, disclosure of qualitative information is permitted under some circumstances, particularly when a company cannot separately identify the effect of the particular risk or opportunity, or where the level of measurement uncertainty is so high as to render the measurement not useful. We'll repeat this phrase a number of times, but when preparing disclosures on anticipated financial effects of risks and opportunities, S2 simply requires companies to use all reasonable and supportable available information at the reporting date without undue cost and effort, using an approach that is commensurate with its circumstances and skills. So that just recognizes that some of these disclosures are difficult at the moment. For the purpose of scenario analysis, it's to be used for assessing the company's resilience to climate risk. But bear in mind that S2 does not set out the particular scenario that is to be used. That is for the company to determine. And having conducted the scenario analysis and determined then the company's resilience, S2 asks the company to provide information on significant areas of uncertainty it has encountered during its assessment, whether and to what extent the company has the capacity to adjust and adapt its strategy and business model over time to remain resilient, and details of when and how the scenario analysis was carried out. So we mentioned earlier, didn't we, that one of the responses a company can have to the effects of climate-related risk and opportunity is to set a climate transition plan. Now, it's important to note that a company doesn't have to have a climate transition plan according to the ISSB standards. There might be local laws that require it, but the ISSB standards don't. However, if a company does have a transition plan, it must provide information about it. First, let's look at the definition of a transition plan. It is an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including GHG emissions reductions plans, for example. Now, as it is an aspect of the company's overall strategy, of course, the climate transition plan should align with that strategy, with the business case, business motivation, and decarbonisation levers that are most economically and technologically feasible for the company to apply. Secondly, it should align, if possible and appropriate, with the goals of science, including what science has to say about net zero pledges and how they will be achieved, climate neutrality goals, and Paris-aligned commitments. The transition plan should set long-term goals with clear mitigation and adaptation activities and targets to achieve them, and of course, interim milestones. Of course, the transition is going to be uncertain, and therefore the company should be transparent in its disclosures about the dependencies, risks, and challenges of executing the transition plan, and should explain how residual or unabated greenhouse gas emissions will be handled. The transition will look different for different sectors, and therefore it should be useful to follow sector-specific pathways for the transition, and we'll look at some guidance on that in a moment. And companies should bear in mind that the transition plan will be evaluated by investors and others, and it should therefore have the hallmarks of credibility that those users of the transition plan have set, and we're going to look at some guidance on that. And what you'll be glad to hear is that there's loads and loads of resources on transition plans. And what you see on this slide is just a very small sample. The triangle on the left is only designed to tell you that some of the organisations that set out this guidance, including the Glasgow Finance Alliance on Net Zero and the Transition Plan Task Force, they have developed their work that supports the IFRS sustainability disclosure standards. But let's look at some of the guidance. First of all, the IFRS Foundation has produced its own guidance on disclosing information about an entity's climate-related disclosure transition plan in accordance with IFRS S2. That's less than a year old, that guidance, and has lots of information and examples about transition planning. The UN Sustainable Stock Exchange has also published model guidance on transition plans, and that also contains lots of practical information about transition planning and how you could, and also has an appendix setting out the characteristics of a credible disclosure plan, as we just described. There's also guidance from GFANS, we just mentioned, and the Transition Plan Task Force now within the ISSB's management. And you can find these resources in the links that Fiona's kindly provided in the chat. So you'll be glad to hear that we're now going to have a short break, just 5 minutes. So do take this opportunity to think about any more questions you have to ask us, to have a stretch, go and get a drink. I will play you some relaxing music and see you back here in 5 minutes. Hello, everybody, and welcome back. Hope you had a good, albeit short, break. Somebody mentioned in the Q&A that they couldn't hear me very well, but I'd just be grateful if one of my colleagues, Fiona or Robert, could just confirm that they can hear me okay.
All fine on my side, Lois. So I think unfortunately it might be that individual's speakers, but yeah, I hear you.
Oh, good, good. I'm sitting nearer to the mic anyway. So let's move on to our next core content area then. The next core content area we're moving into is risk management. So this category of disclosures focuses on enabling investors to understand the company's process to identify, assess, and prioritize and monitor sustainability related risks and opportunities. So when looking at the content areas to date, we've been looking at information about risks, about governance. This is about process in this particular section. So the sorts of questions you'll need to be asking internally to make disclosures in response to this core content area are what policies and processes are being used to identify, assess, prioritize and monitor sustainability related risks and opportunities, and how, if at all, are they integrated into the company's overall risk management process. So you might be starting to ask questions internally about what type of inputs and parameters are used for risk management, how sustainability related risks and opportunities are prioritized, and are there different criteria used than for other types of risks and opportunities, given that the nature and uncertainty of sustainability related risks can be different, and also look at whether and how processes have changed since the last reporting period. Let's have a look at an example to illustrate this. Now, this extract comes from BMW's 2024 group report, and I'm sure you all know that BMW is a car manufacturer. And here BMW describes the process for risk management in words and in a diagram. So you've got a little extract from the narrative that describes the process and tells us that risks and opportunities are reported for current and subsequent years. But what I want to focus on here, because it summarizes quite neatly, is the process this company uses. So there's a dark blue circle around which we see the words appropriateness and effectiveness. Now, appropriateness refers to the risk culture embedded in BMW's core values. This is likely to be something in most companies that is set for general risk management. And effectiveness refers to the effective management of risks and opportunities. And you can see from the little narrative extract that the company says this is the foundation of their business success, effectively to manage risks and opportunities. Down the left-hand side of the circle, you can see that the risk management system interfaces with group compliance management system and with the internal control system. So just like we saw with governance, the process for risk management on sustainability is not the responsibility of the risk department alone. It interfaces with internal control and compliance management. In fact, in this company, risk management is a centralized management function organized globally, but supported by a decentralized network with different network representatives. In the middle of the blue circle, in the light blue wheel, we can see that the process itself involves early identification of risks, analysis and evaluation of risks, using appropriate risk management tools, including measures taken to manage and monitor the risks, how those risks are monitored and assessed, and also risk reporting. And once the risks have been through this process, they're reviewed by the Risk Management Steering Committee, which you can see in the circle on the right-hand side. And those material risks are then reported to the Board of Management and the Supervisory Board's Audit Committee. So quite a sort of neat description of this integrated risk management process. Let's continue with our look at the climate-specific considerations on risk management. And S2 requires a company to provide information about the input parameters they have used to identify risks, whether and how climate-related scenario analysis is used to inform risk identification. Primarily, it's used for resilience assessment, but can also inform risk identification, and how the processes to identify, assess, prioritize, and manage risks have been integrated into the overall risk management process. So with S2, we can also see that we have a definition of climate-related risks. There are two main types of climate-related risk, transition and physical. Transition risks arise from efforts to transition to a lower carbon economy, and they're often categorized as policy, legal, technological, market, and reputational risks. Now, we've got some examples of that in the middle of the screen here. Transition risks can include pricing of GHG emissions, more reporting obligations, exposure to litigation, cost of transition to lower emission technologies, changing consumer behavior. I think we saw that, didn't we, in the Marks and Spencer's example earlier, and so on. With the physical risks, we have acute physical risks which arise from weather-related events such as storms, floods, drought, and heat waves, which are increasing in severity and frequency around the world. There are also chronic physical risks that arise from longer-term shifts in climatic patterns, changes in rainfall and temperature, sea level rise, changes in water availability and quality, biodiversity loss, and so on. Now, in both cases, transition and physical risks can carry financial effects that can impact a company's cash flows, access to finance, cost of capital, and these financial effects can be felt over different time horizons. Similarly, S2 defines for us what is meant by climate-related opportunities. These opportunities come from efforts to mitigate and adapt to climate change, often very much of interest to investors, actually, how opportunities are being maximized. They can come from being more resource efficient, changing to lower emission sources of energy, developing new products and services to respond to changing consumer preferences, being able to access new markets, and increasing the company's resilience. And again, these opportunities have financial effects over different time horizons. Now we're going to look at an example now from a company called RS Group. This is a UK-based distributor of electrical and industrial equipment, and they have global operations. In this extract, we're focusing on physical risks. And bear in mind that the company earlier in the report has identified 10 principal risks, one of which is climate-related transition and physical risks. So here they're just building some detail about physical risks. The most significant physical climate risks that affect this company relate to the impact of extreme heat on their distribution sites. You can see that on the first row. And the impact of extreme weather to cause physical damage and disruption to their customer supply operations. You can see on each line that there's a little red wheel icon, and this shows that strategically the risk mainly affects operational excellence. You can also see how the risk is connected to different stakeholder groups. Moving across the columns here, you'll see that the company describes the risk. They explain which business owners are responsible for managing the risk. They itemize the metrics they use to monitor the progress of the risks. And they also tell us what initiatives they have in place, including for future years, to monitor and, in some cases, invest in adapting to and managing the risk. So that brings us to the end of the risk management core component, and we're going to turn back to Robert now to take us through metrics and targets.
Yes, thank you very much, Lois. Yes, we'll now move to the final key core content area, metrics and targets. We'll then discuss them more in detail. So let's start with metrics. So requirements on metrics are designed to enable investor to understand company's performance in relation to its sustainability related risks and opportunities. So preparers should disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. For example, what is the method of calculation, what are the inputs, and what are the limitations and assumptions involved with this metrics. Now moving to targets, requirements on targets are then here to designed to enable investor to understand what are the targets, the goals the company has set to monitor progress towards achieving its strategic goals, as well as any targets required to meet for regulatory purposes. So disclosures here include some specific requirements on the disclosure, whether their targets are qualitative or quantitative, and whether it's set voluntarily or whether that's required by the law or regulation. So obviously the target should disclose the metric used to set it, and how the metric what the metric is then set to monitor the progress towards the achievement of the target. Additionally, the baseline period from which progress is measured and period to which the target applies. Additionally, also the milestones and interim targets, if there are any, and also whether there have been any revisions of the targets together with the explanation about revisions. And how these metrics and targets can work in the company. We have another example. Over to you, Lois.
Thank you, Robert. Yes, this example is from a company called CLP, from their sustainability report. And CLP is one of the largest investor-owned power businesses in Asia Pacific and aims to be a leading responsible power provider. Now, you will have noticed that many of the examples we've shown you up to now have been to do with climate change or have included something to do with climate change. Here we have an example of metrics and targets that are to do with waste management, pollution, circular economy, and material use. So this extract explains CLP's objectives, which are to integrate circular economy into its operations, and they've set group-wide medium and long-term waste targets for the years 2025 and 2030. So these waste targets to be met through things like recycling of waste electrical, recycling of rechargeable batteries, as you can see from the table at the bottom of this extract. They also show us what their 2024 results were and whether their 2024 results are in line with progress and what the target is by the end of 2025. So they tell us that how much they've reduced their different pollution and waste metrics, and what percentage of their targets that they've achieved. So in most cases, 100% of the target has been achieved. Now, a few other things I want to mention here. First of all, in that first box, you can see in the pale grey writing at the bottom that the company tells us SASB reference, an EU reference, and a GRI reference. It tells us that the metrics were calculated in line with SASB and GRI frameworks. So this is because ISSB does not currently have a standard on waste management and material use. And also the other thing I wanted to mention here is the link between the targets metrics and the company's strategy. So it's an example of the principle of connectivity we saw earlier. I think it's back to you now, Robert.
Yes, indeed. All right. We talk about metrics and targets in general terms, and now we'll be now focusing on and talking a little bit more and zooming in, um, um, discussing metrics and targets in the climate specific context. So, in relation to metrics, IFRS still requires a number of specific disclosures, including following disclosure of industry-based metrics relevant to a company business model and activities. Additional disclosures are also required for on greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associated joint ventures and information about companies' finance emissions. Additionally, IFRS S2 sets out Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emissions disclosures. So, importantly, why IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions by the constituent gases, IFRS S1 includes requirements on disaggregations that would result in the disclosure of the gases being required of such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We'll share the link in the chat, and you can also find it on the website. Moving on to further on climate-specific metrics. As the metrics are some disclosures similar to the targets, their following requirements are set. So, for example, IFRS still requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. The standards also requires disclosures of more detailed information on greenhouse gas emissions, including additional information about any planned use of carbon credits to achieve a company net greenhouse gas emission targets. Also, IFRS S2 includes additional requirements to disclose information about the approach of setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. So we've been talking already for a while and mentioned it a few times, greenhouse gas emissions. Now let's zoom in and talk about the metrics related to this matter. So questions on greenhouse gas emissions often come up on metrics and targets disclosures. So let's introduce them and address them here briefly. So for those who might not be familiar with different scopes, we have three different scopes on greenhouse gas emissions. So the scope 1 includes all direct emissions that occur from sources owned or controlled by a company, such as emissions from the company's facilities or vehicles. Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And scope 3 then will be all other indirect emissions that occur in the company's value chain. So what the standards requires here? First of all, it requires an absolute gross scope of 1, 2, and 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol Standard, Greenhouse Gas Protocol Corporate Standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use the methods in the first year of applying the standard. Whether and how the company is using an internal price on carbon for decision making, that's another requirement. And thirdly, the company needs to disclose whether and how executive remuneration is linked to climate related considerations. To add here, in May last year, the IFRS Foundation has published educational material presented in a Q&A format detailing the greenhouse gas emissions disclosures requirements under IFRS S2, including measurement, the use of the greenhouse gas protocol, and how to report scope 1, 2, and 3 in line with the standard. And Fiona just sent a link to this material in the chat. All right, so we will have now another example to this topic. Over to you, Lois.
Thank you, Robert. And this example is from the Integrated Report 2024 of a company called Vale, which is a metals and mining company based in Brazil. So it's quite a busy diagram, but the things to note are this. The tables on the left-hand side under the title GHG Inventory show the company's greenhouse gas emissions broken down by scopes 1 and 2 and scope 3. They also have here comparative figures dating back to 2022, and they show us the baseline year from which GHG emissions reductions targets were set, and we'll come back to that in a moment. So this way of presenting the breakdown between emissions and the comparative analysis over years enables you to see the trend, and it enables you to see which scope is the majority represents the majority of greenhouse gas emissions. As well as the breakdown by scope, we have a breakdown by source. So that's indicated by the colourful wheel on the right-hand side of the screen under the title Emissions by Source. And you can see from the colours that mobile combustion activities give rise to the most greenhouse gas emissions by source, followed by industrial processes. So for an investor or other reader who wants to know where are these emissions coming from, you can see that from the way the company has broken this down. Notes and symbols tell us how results have been prepared. For example, you can see in the little pale brown boxes that the company's used GRI standards to calculate these greenhouse gas emissions, and GRI requires the use of the greenhouse gas protocol that Robert just mentioned. Note 1 tells us that the GHG emissions inventory has been assured by a third party. And Note 2 explains that the emissions have been reported on a gross basis before any type of compensation, and that certainly is in line with the requirements of S2. At the bottom of the page, there's an overview of the company's long-term commitments on climate change. So this is just an extract. It tells us that the baseline for scope 1 and 2 targets were set in 2017. The aim is to reduce emissions by 33% by 2030 to achieve net zero emissions by 2050. The company also gives us a status report and tells us by 2024 the company had made 81% progress towards that target, and there's a similar analysis for the scope 3 emissions targets there. So quite a lot of detail, well illustrated with tables and diagrams. Let's go to a Zoom poll now. And this question is, what is the objective of metrics? And in particular, what we mean is, what's the objective of the metrics requirements in the ISSB standards? Now you can you'd have a multiple choice here. So select all that you think apply. Is it to understand performance in relation to the company's sustainability risks and opportunities? To understand progress towards targets, as we just saw in the example, or to understand the company's assumptions for the future? Right, got good participation now, so let me share the results with you, and you'll see that yes, most of you selected A and B, and that's absolutely correct. Now, the reason we asked you the question in this way is because at the beginning of each of the requirements in the standard, you'll see that the requirements set out the objective of the requirements. Now, if you follow those closely, it should help you to sort of craft your responses accordingly. C is not incorrect, but that's not what it says in the objectives. So the short lesson here is always read the standards and see what the objectives are. So I'm going to hand over to Danielle now to take us through the next section.
Thank you so much, Lois, and thank you all so much for staying engaged with us. So now we're going to move over to Align. So now that we've covered all the core content of disclosure that meets the ISSB standards, you all are very aware, though I'm sure, that there are often additional regulatory requirements or other additional disclosures that companies will need to consider. So this final section of the Align unit will briefly cover that. So to start, we know that many companies already disclose against voluntary and mandatory reporting standards based on their own jurisdiction, stock exchange regulations, and other industry norms. These can include things like local requirements. Both listed and non-listed companies must meet and comply with jurisdiction-specific disclosure requirements. Companies in your supply chains should also be prepared to provide necessary information upon request. There are policy objectives. Companies should familiarize themselves with policy objectives aimed at promoting sustainability. Governments may offer incentives like tax cuts or subsidies for sustainable practices. They may also implement disincentives for activities counter to national objectives. Companies may also need to provide additional disclosures to align with emerging industry practices and effectively manage sustainability-related risks and opportunities, depending on their specific sector. Companies should also identify other stakeholders and their requirements through materiality assessments to ensure comprehensive disclosure practices. So looking at national regulators who are actively considering how to incorporate the ISSB standards into their domestic frameworks, this includes decisions on timing, scope, and alignment with existing reporting requirements. So as many of you likely know, as of December 2025, 39 jurisdictions have adopted, used, or are taking steps to introduce the ISSB standards into their legal or regulatory frameworks. Together, these jurisdictions account for about 60% of global GDP, over 40% of global market capitalization, and 60% of global GHG emissions. And thank you to Fiona for providing a link in the chat. With the update of the foundation has released 17 jurisdictional profiles showing regulatory decisions and alignments with the ISSB standards. In addition, 16 jurisdictional snapshots provide updates on the jurisdictions still consulting or designing their approach. This marks a significant milestone in achieving a global baseline for sustainability disclosures. Profiles provide transparency and reduce uncertainty for investors, companies, and regulators. They support the interoperability agenda, ensuring jurisdictions can build on the ISSB global baseline. They help capital markets access consistent, comparable, reliable sustainability information. Profiles complement the May 2024 jurisdictional guide and are developed through bilateral engagements and independent review. The IFRS Foundation will continue supporting jurisdictions via their jurisdictional sustainability consultations, regulatory implementation program, and their roadmap development tool. So on voluntary reporting standards, the IFRS is actively supporting jurisdictions and non-jurisdictional stakeholders to ensure that the ISSB global baseline meets investors' needs and has good interoperability, reducing duplication and improving efficiency of the reporting system. Many of the decisions taken to develop the ISSB standards have helped advance interoperability. For example, using the TCFD architecture as the basis for our standard facilitates interoperability with existing disclosure requirements. CDP's ISSB's key global climate disclosure partner, and from 2024, the CDP questionnaire is aligned with IFRS S2. In addition, the IFRS Foundation is working closely with the GHG Protocol, GRI, and others on this issue. IFRS and GRI are looking at ensuring the maximum interoperability between their standards, again, to facilitate efficient and effective reporting by companies around the world. In June 2025, the GRI Global Sustainability Standards Board, or GSSB, granted equivalence to IFRS S2 climate-related disclosures for Scope 1, 2, and 3 GHG emissions under GRI 102. To be able to use the equivalent S2 GHG emission disclosure, organizations reporting in accordance with or with reference to the GRI standard would have to measure their greenhouse gas emissions in accordance with the Greenhouse Gas Protocol, which is a corporate accounting and reporting standard out in 2004, and include a reference to the location where the information for each of the disclosures can be found as per the Publish a GRI Content Index requirement in GRI 1 Foundation that came out in 2021. So looking at IFRS and EFRAG have also been working closely to support interoperability between ISSB standards and the European Sustainability Reporting Standards. Many companies are expected to choose or be required to apply both ESRS and ISSB standards. In jurisdictions around the world, the ISSB standards as a global baseline, companies will be better prepared to meet disclosure requirements anywhere in the world. The high degree of alignment between ISSB standards and ESRS reduces complexity and duplication for companies applying both. The ISSB standards facilitate decision-useful information targeted at capital markets, enabling global comparison for investors. Joint guidance published by IFRS and EFRAG provide practical support that explains how companies can effectively comply with both sets of standards. The Integrated Reporting Framework provides principle-based guidance for reporting structure and content. When used together, the ISSB standards, including the source of the guidance, the Integrated Reporting Framework, can support a holistic view of the value creation process through governance and business models, disclosure to drive connectivity between financial statements, and sustainability-related financial disclosures. As such, it supports high-quality corporate reporting, and when it is underpinned by integrated thinking, it can enhance a company's quality of corporate governance. And so now we are going to have a Zoom poll. And so you can see here, the question is, my disclosure objective should consider A, the ISSB standards only, B, the ISSB standards and regulatory requirements, C, just regulatory requirements, D, the ISSB standards, regulatory requirements, and other sources of guidance. And so we will give people some time on this one. I know some people had asked for a little more time on the poll. So thank you. We're actually almost at 50%, which is wonderful. This is great. So again, you can look at A, B, C, or D. I like how some people are using the chat. If you can use the poll, that's great too. All right, we have passed 50%. So I think we'll end the poll there. And let's see, you can see. Okay, great. So the majority of you got this correct. It is D. And it's important, of course, to make sure that you consider all these inputs when developing your organization's disclosure objectives to ensure a holistic approach that meets all relevant requirements and stakeholder expectations. And with that, we will hand things back over to Fiona.
Great. Thanks so much for that, Danielle. Okay, brilliant. So that brings us up to the end of Align then and our second module. And you might be thinking, goodness, we've already been here over 2 hours and we're only finished our second module. Don't worry, that was a big one. We know there's a lot to cover to get clear on those content requirements. So we're well more than halfway through the session, you'll be pleased to know. But let's take a minute now just to remind ourselves of what we've learned so far. So in this module, we reviewed those 4 different core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But of course, an important thing to remember here is that these don't operate in silos. And we saw in the disclosure examples that we talked through that despite having 4 separate categories of disclosure, of course, in practice, this is all very interconnected within each organization. And then we also discussed here in the second part of the module how your disclosures might go beyond the requirements of S1 and S2. So, for example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or of course, to meet industry requirements as well. What's important to remember when you're doing this is that the ISSB standards have been purposefully developed to act as a baseline. And so that building blocks approach will allow report preparers to add additional disclosures on top. But of course, in doing so, the tricky balance to strike is that you need to be careful not to obscure those requirements of S1 and S2 and to ensure that the concise material information that your investors need is still accessible as well. So we'll talk a bit more in our communicate module about some techniques that could support you in doing that. But again, we'll wrap up this module with another exercise together. So in this exercise, we're going to be thinking now about the key gaps that we might need to address in our current disclosures or internal practices. So far you've heard about a lot of different content requirements, processes, and probably that's brought to mind for you already some things that perhaps in your organization or the organizations you're working with, you know are going to need to be addressed or implemented to meet these new requirements. And so, of course, what we would recommend that you do as part of your disclosure plan is to conduct a thorough gap analysis to understand what these gaps are. And there's a checklist available in the homework handout, which can help you to work through that exercise. But let's take a moment now to reflect together, or maybe what's front of mind for you as some key gaps. And so you could think here about a couple of different things. You could think about particular content requirements in your reporting. So maybe different topics you need to report on, or maybe different information you need to provide. But you could also think as well about your internal processes. So, are there new reporting processes you need to develop, new skill sets you need to bring into the organization, or maybe additional colleagues to speak to on new topics of disclosure as well? So take a moment just to reflect and feel free to share maybe 1 or 2 key gaps that are front of mind for you. So as a reminder, we're back in Menti for this exercise now. I'll just share the link again in the chat so that you have that close to hand, but I see many of you are already there. And let me share my screen now as well to show you the results coming in. Okay, great. We got some poll responses in this way as well. Everyone was really keen on option D, which you were right, so that's good. But looking at the responses relating to gaps, so someone's mentioned maybe they haven't started yet. Well, that's okay, we're getting started now. So have a little think and think what might your gaps be. So what else are we seeing? So addressing more measurable metrics and targets. Yeah, that's a common point, I think. For many organizations, you may have had more narrative and qualitative disclosures to date. But of course, what we're calling for now is more standardization and quantification of those material sustainability related risks and opportunities. So that is a common area that many organizations have to get to grips with. We then see someone mentioning around maybe not having standardized and consistent data. So maybe a related point, but absolutely the data quality for that reporting. Someone has also mentioned maybe internal controls. So yeah, maybe you haven't necessarily got the maturity in your reporting processes internally yet to move from those rough estimates and techniques that are quite inaccurate towards more robust processes. So thinking about how you can build up clear assumptions behind how you're reporting, standardized approaches to reporting your different metrics will be a good place to target some activity. I agree. So someone's mentioned as well how to assess the risks and come up with actions across departments. So it's great that you're highlighting the need to work across departments here. Of course, that's really critical. So I think that's a great starting point to understanding these risks is indeed bringing together your colleagues across different parts of the organization to assess that in a holistic way. So encourage you to, as much as you can, utilize the approach of your existing enterprise risk management to enable you to conduct those assessments. Discussing with different teams, harmonizing the data, so maybe a similar point, and then finding a way to make an accurate financial materiality assessment. I know that's reflected in a few of the questions we've had as well, and we will be coming back to determining materiality later in the training as well. Someone's mentioned around aligning with industry practices as well. So yeah, thinking about what are good comparable and consistent metrics to use. So that's where we recommend drawing upon industry-based guidance and the ISSB standards to support you in identifying those suitable metrics. So let's see, data quality coming up again. Someone's mentioned scope 3 emissions. That again is also quite a common thing we see raised here. We know that can be obviously very challenging for organizations to get accurate data on, but starting to at least conduct that assessment of your different scope 3 categories to understand which are material for you, maybe starting with estimation methods to get a sense of their relative proportionality, and then targeting your efforts to build out better data from there. Engaging with supply chain and other stakeholders will be good. Someone's mentioned expertise and maybe competencies. So that's a common problem as well. Of course, there's a lot that's new to this. So, understanding what skill sets you do have internally, and maybe doing a bit of an assessment of that could be a very good exercise too, to help you identify maybe any recruitment needs you have. Also, maybe any areas where it would be beneficial to work with third parties and consultants, perhaps, to help you plug those gaps in the near term. But of course, building up the expertise of your internal teams to help them understand their roles on this topic and the application in different areas such as risk, accounting, etc., will be really important as well. Okay, so what else am I seeing? Someone else has mentioned around scenario analysis. Yes, again, a common kind of more technical area that we see highlighted here too. So as this person's highlighted, you do need to be looking over those longer term horizons here and thinking about different scenarios. So yeah, it's good that you've identified that as something to action, because it's definitely something that can be quite new for organizations to get to grips with. Okay, lots of people have good reflections here, so this is helpful. Thank you, everyone. So data and materiality, scope 3, climate risk, are coming up with some similar gaps here. So at least I think one thing of this exercise is knowing we're in good company and all grappling with similar challenges here. Someone has mentioned the interoperability common as well. So indeed, we hear that mentioned, and of course that's reflected in multiple questions we've received today. Of course, too, that it can be a little bit hard to navigate. What's mandatory, what are the needs of different stakeholders, and so of course we encourage you to look to those interoperability mappings that we talked about there, that can help you to see the connection between the ISSB disclosure requirements and other frameworks and standards. So actually, you'll see that there is a large degree of overlap in what they're asking for. But of course, there can be a little bit of a challenge in making that information coherent and meeting those different requirements as well. Okay, so I think I'm seeing some similar themes there, but just to wrap up this section, of course, it's understandable that we'll all have gaps, but what we really encourage you to do is to take away some of these areas that are front of mind for you and use them to start to build out a fuller gap assessment. Because from here, then you can really start to prioritize those issues in the order of how you address them. What you may find is that some of these gaps are more significant and more foundational. And so they're things that you really should be aiming to get in place now to set the foundation for your processes, to build the right governance, etc. But some of these areas may also be things that you could start to improve and evolve over time as reporting matures. What's really important in your disclosures is that you provide that transparency about those areas that you're continuing to work on. So you don't need to necessarily have everything to hand at this point, but you do need to use the standards to provide that transparency about any areas of uncertainty or, for example, areas of data quality that you're continuing to develop. So building your own internal understanding of this is also a really important informant to your disclosures as well. Lovely. Thanks everyone for again, lots of great input to the exercise. Makes my job very easy to talk that through with you. So that will get us started now on our third module, which I'll hand back to Lois for.
Thank you, Fiona. And so far in the training, we've been very focused on what it is that companies should be reporting. What do the requirements say that must be disclosed? But we're actually going to move on to now to think about implementation, the backbone of effective disclosure, how disclosure is done, starting with the practices and processes needed to collect the appropriate information for disclosure. We've got three sections in this module. First, how to identify sustainability related risks and opportunities. Then Fiona will take us through the evaluate section, which looks at things like scenario analysis. And thirdly, we'll look at how you can integrate sustainability disclosure requirements into your existing processes. So let's start off with how to identify sustainability related risks and opportunities. So bear in mind that IFRS S1 asks companies to provide material information on all sustainability risks and opportunities that could reasonably be expected to affect a company's prospects, and S2 sets out the requirements for climate-related disclosure. But what about risks and opportunities beyond climate? Well, in that case, S1 directs companies to sources of guidance to support them with the identification of risks and opportunities beyond climate and to help them identify what type of information to disclose about those. So first of all, S1 says that consideration must be given to the ISSB standards, and you can find those linked to the S1 and S2 on the IFRS website. In addition to the requirement to consider ISSB standards on sector-specific risks, opportunities, disclosure topics, and metrics, companies can also consider IFRS educational material. And I think we will be able to provide a link to the educational material on sustainability-related risks and opportunities and the disclosure of material information. There's lots of help and guidance in that particular material. The CDSB framework application guidance, now consolidated into the IFRS body of work, has application guidance on different types of risks, including social, human risks, human capital risks, water, forest, biodiversity, etc. Companies can look at industry practices. In the Q&A, I think we have referred people to guidance, for example, issued by the Metals and Mining Institute, if you're in that sector, similar stuff for oil and gas industry. And you could use the materials of investor-focused standard setters like the Integrated Reporting Framework. So once you've done that, what information should you provide? Well, the IFRS S1 refers you to the same standards, but in addition, you can use GRI standards or the European Sustainability Reporting Standards. So we saw this, didn't we, in the CLP example, where they had used ISSB and GRI standards to help with their disclosures on waste and circular economy metrics and targets. So let's have a look now at an example on a risk process for identifying sustainability-related risks and opportunities. This is an extract from a company called Ayala from their 2024 integrated report. Ayala is a Philippines-based conglomerate with lots of different types of business activities. But the extract shows that their risk identification process also has always has at its heart communication and consultation with the various internal and external stakeholders who can inform the company about the risk landscape. And step one, we see in this 4-point process, builds on that by establishing the context for understanding the identification of risk. What are the internal and external factors that need to be taken into account? And in setting this process, the company describes the outputs and the responsibility for identifying risks and opportunities. Secondly, the company assesses the risk, they identify, analyze, and evaluate it so that they understand the risk universe. They then decide how to treat the risk. What risk treatment plan will they put in place and who will be in charge of it? What is the appropriate plan of action? Remember, we saw the word appropriate in the BMW example as well. And finally, they have a monitoring and review process. So certainly companies should and must use the sources of guidance that we looked at on the previous slide, but there's probably also going to be a process into which the company can integrate that. There's another example now from Nest. Now, some of you have asked whether scenario analysis can be used to inform risk identification, and this is an example where that's what the company's done. Nest is a company based in Finland that's a producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. The extract comes from the climate section of its annual report, and it shows how risk and opportunity identification is informed by two different scenarios over a time horizon to 2050. The effects of the first scenario, which they call Net Zero World 2050, are considered both on a global basis and for the EU and North America. And this is because different economies will take action at different paces. So they've distinguished between those two regions. In both cases, the company anticipates opportunities in a net zero world 2050 because action will be faster and they anticipate growing demand for renewable and circular solutions. On a global basis, they can expand into new markets and sectors, and in the EU and North America, they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambitions. Of course, they identify risks too, associated with competition and the acceleration of new technologies. As you might expect, in the compromised climate target scenario, where climate action is slow and global warming of 2.5 to 3 degrees is expected, again, there are risks and opportunities. The risk is that the demand for those products will be constrained in a compromised climate targets world, but the opportunity is for the company to differentiate itself from others because of its offering of renewable and circular solutions. So there's a case in which we see scenario analysis used to identify or inform the identification of risks and opportunities. I won't go into this in detail because we've mentioned it before, but again, the standards recognize that it can be difficult to identify these sustainability related risks and opportunities, and therefore allows companies to use just the reasonable and supportable information it has at the reporting date without undue cost and effort. What does that mean? Reasonable and supportable information is specific to the company, so it will be known to the company. It takes account of the external environment, as we saw in step 1 in the Ayala example. It includes information about past events and current conditions, of course, that the company will know, but can also include forecasts, and maybe that's what the Nest example was trying to do using scenario analysis. And in some cases, what is proportionate and commensurate will be specified by the standards themselves. Now, Danielle's going to take us through the next section on evaluate.
Thank you so much, Lois, and thank you all of you for staying so engaged in this exciting topic. So we are now looking at implement. So once the risks and opportunities are identified, companies need to evaluate the financial effect of those risks and opportunities. This can often be the most daunting when first starting. So we will briefly review a few key concepts that will help in this process. To help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. It also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. For example, you might test your company's resilience against new regulations to limit certain high emission activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. To do this, you'll use scenarios based on science and analyze how those scenarios will lead to the company's incurring effects. It's important to remember scenario analysis does not require you to predict the future. It's a tool to test your resilience against potential future events. S2 does not specify which scenarios a company shall use in its analysis, but does require the company to use relevant scenarios and provide information about the scenarios it has selected, to provide information about other relevant assumptions it has used in the scenario analysis. And S2 also includes guidance on how a company can determine its approach to scenario analysis. This encompasses a range of practices from qualitative scenario narratives to complex statistical modeling. Considering this, the ISSB standard requires a company to use an approach that is commensurate with the company's circumstances and use all reasonable and supportable information that is available to the company at the reporting date without undue cost or effort. Let's use an example now to zone out a bit and see how this comes into our disclosure. So we're going to see another example from Nestle. You're, again, probably familiar with the Swiss multinational food and drinks company. Here, we see one output from their climate scenario analysis from their 2024 non-financial statement. This visual shows the potential impact of physical climate change on the yield of 12 of their key agricultural commodities for 2040 under a medium emissions scenario. The modeling metric is the projected percentage change in crop yields to 2020 to 2040 compared to 2022. The analysis projects that increased heat waves, droughts, and water stress could affect the availability and quality of key raw materials that could in turn lead to increased price volatility and input costs. Yield reductions for some raw material may affect supply chain stability. Their disclosure then goes on to summarize the key outcomes of their analysis for different aspects of their business and the steps that they are taking to improve their resilience. In response, the company has set out potential effects on business model, resilience, strategic and financial planning, product innovation, operational efficiencies, R&D initiatives, leveraging science, for example, and engagement and advocacy. Anticipating the materiality of information about possible future events can also be particularly challenging. To help with this determination, IFRS S1 asks you to consider a number of issues to help you with your determination. You could think of this as identifying all the steps and information you need to come to your judgment. For example, companies should be considering all low probability but high impact events. Any uncertainty related to the company's future cash flow should be evaluated. And another important point here is the need to reassess uncertainties at each reporting period through the ISSB. Though the ISSB doesn't require you to do scenario analysis every single time. Rather, scenario analysis can be done in line with your company's strategic planning cycles. And with that, I will hand things back over to Lois.
Thanks very much, Danielle. So yes, we're moving to the last part of this module, integrate, how to develop new processes and integrate new considerations about sustainability into your existing processes. Now, the good news here is, and many of you have asked about how to do things, is that your company is likely to have processes, systems, and policies that can be used to help manage sustainability disclosure. So we're going to talk here about the processes you already have, how they can be used, and whether you need to change or add to them. So when considering what you already have and whether you need to create or adjust processes, we have a list here of questions you might want to ask. So is a gap analysis appropriate? So you can check whether there are gaps in existing systems and processes that might need to be filled in order to comply with sustainability disclosure requirements from the ISSB. Are your existing processes and prioritization criteria suitable for identifying and prioritizing sustainability related risks and opportunities? We know that these manifest over longer and different time horizons, that they're much more uncertain. So is it that you need to extend the type of criteria used for prioritization to include things beyond probability and likelihood to cover impact, vulnerability, and speed of onset? Can the company's existing internal controls processes be used to evaluate the relationship between controls and risks, for example, as we saw in the BMW example? Importantly, what people will contribute towards the sustainability disclosures? Which departments, which people, experts internally and externally can help you because they have knowledge, processes, and systems that can contribute towards disclosure? What are the interconnections between different internal and external factors, and how could they be managed in the process of developing your disclosures? There will be uncertainties when you're looking at sustainability related risks and opportunities and what to disclose about them. And it'd be good to have a policy or process that explains how you'll deal with those uncertainties. We saw that where uncertainties are so great when we're trying to measure effects, that the standards allow qualitative information to be provided instead. So is that one way of dealing with uncertainties, and should that be enshrined in a process? And finally, think about what resources you'll need if you need to develop existing processes or to devise new ones. Will you need to go through a change management or a budget request process to do that? So all of these questions can help you. In addition, we suggest that developing a disclosure plan as a standalone strategy or as part of a wider corporate disclosure strategy can help you. Can help take control of your narrative. That is to focus on your company's strategy, your company's risks and opportunities, rather than just making disclosures that are generic. You want them to be specific to your company. The disclosure plan can help support internal collaboration, knowledge sharing, and cross-functional team discussions by writing down in the plan who is responsible, who has different processes and systems, how can they be accessed, what are their timelines, etc. And most importantly, I think, the disclosure plan can act as a reference point and an audit trail describing where and how judgments have been made that affect how you make your disclosures. It can record how data has been sourced, which systems have been used, whether and from whom assurance has been obtained, what goals and requirements need to be managed and over what timelines. It's a whole plan to manage your disclosures and keep a record, and it makes things easier when you embark on each reporting year. Here's an example from a company called Novo Nordisk, which is a Danish pharmaceutical company, that illustrates the basis on which the company is reporting and records things that you might want to put in a disclosure plan. So you can see in the first panel that they list the standards and guidelines that they've taken into account when preparing their disclosures. There's a long list of them: the GHG Protocol, Science-Based Targets Initiative, the TCFD, the GRI, their local laws, the Danish Financial Statements Act, and so on. So the reader understands the basis on which the disclosures have been made. There are lots of other things in this extract which I won't go into in detail, but briefly you can see they describe the time horizons over which they're reporting, and they define the time horizons. They explain when they've had to make estimates and the assumptions they've used to support those estimates, and a range of other helpful contextual information. And you can imagine that agreeing this before you start preparing the report is going to be really useful. So let's do a Zoom poll now with you, and you can only answer yes or no here. So, is a disclosure plan required by the IFRS sustainability disclosure plans? You can answer yes, and you must disclose your plan, or B, no, but it's a very helpful tool. Give you a minute to think about that. Oh, the results are very close. In the interest of time, I'm going to end the poll and share the results. You'll see that you're quite evenly split here, but those of you that answered no are correct. There is no requirement for a company to have a disclosure plan in the ISSB standards. We've just suggested it as part of your homework because we think it's a very useful thing to do. Bear in mind that when I say there's no requirement to have a plan, there are some requirements that you would expect to find in a plan. So there are some ISSB requirements that ask you to disclose how you have prepared certain things, which methodology you've used, and so on. So the disclosure plan would certainly help you to respond to those requirements as well. So well done for getting that correct. And Fiona's now going to take us through a summary of Module 3.
Great. Thank you so much for that, Lois. So this wraps us up on module 3 of 4. So a big well done, everyone, for making it this far with us. So let's just remind ourselves again of a few key points for this module. So let's come back to those connections. In the last module, we wrapped up by highlighting the importance of connections between the 4 core content areas of disclosure. And then in this module, we've learned that there are many connections as well between a company and its external and internal environment. And these connections are what we really need to focus on to identify key risks and opportunities. And the second thing we discussed in this module was relating to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So, as we heard, scenario analysis can be a very helpful tool as it helps us to keep track of those assumptions. But if you're new to scenario analysis, you may want to use some of the pre-packaged scenarios or resources that we've shared with you to help you get started here. And scenario analysis is indeed a requirement for S2 in relation to climate resilience assessment. So we encourage you to take a look at this, but just make sure that you're documenting the assumptions that you're making and you're providing transparency in how you've used that methodology. And finally, as we've seen, even if some of this data might not be information that you're already disclosing, it may well already be something that you're collecting for different reasons. Or perhaps it's that you do have appropriate practices or processes in place that could support you in collecting that data. So as much as you can, aiming not to start from scratch and to build on what you already have in your organizations will be really helpful in terms of approach. So we're going to do our final exercise together now, and we'll do this quite quickly, I think, in the interest of time. So I'll flip straight to the question for you. And this question is just asking you around that point, really, of how to build on your existing processes and systems. So as we've said, as much as you can, using what you already had is helpful. And maybe you have a few ideas that you could share with us about what existing systems there may be in your organizations that either you could adapt or that might be able to provide you with sources of data or information information to assess sustainability related risks and opportunities. So it's always helpful, I think, for everyone to crowdsource a few ideas here for everyone else. So thanks for those responses already. So we're seeing ERP coming up a few times, enterprise reporting platforms, I believe, or processes. So systems that enable sustainability related data, indeed. So that's a good point to make. Someone has mentioned you could also work on internal capacity building, which can support you in collecting the data. So yeah, that's a very fair point. It's not just about the processes, but the people involved in those processes as well, and helping them to know what their role is. So a good point to highlight. Some people have mentioned SAP and your financial and accounting processes. Risk management is another good suggestion there, I would say. Looking at your utilities information can be quite helpful regarding environmental reporting, perhaps. Maybe indeed you already have an EMS, an environmental management system in place. Indeed, so often those types of systems and processes collect a lot of information operationally that can still be really useful at a corporate level as well. So as much as you can, thinking about how you can flow that information upwards to support the processes at a group level or corporate level is really helpful. I see a few people mentioning energy consumption as well, which is a good thing to highlight. HR, of course, for your social information, indeed. Financial reporting systems, I think, is a good point for people to mention here. Of course, these are already set up in the right way with the right sorts of controls, audit trails in place to collect this in a good fashion. So I think lots of great suggestions there. And I think really highlights that you have got the message there that we shouldn't be starting from scratch here. So indeed, what we would highlight is building off of these existing processes. I think it was mentioned, but of course, from the risk side as well, we'd really encourage you to work with that existing enterprise risk management process that you have and ensure that you're integrating or adapting if needed to embed those sustainability related risks into those processes. So lots of great points highlighted there. And I'll leave that question up so that you can scroll through the ideas that others have shared as well. So thanks, everyone. Okay, so as you probably will guess, we're now moving into our fourth and final module called Communicate. So big thanks. I can see Arturo's on hand to take us through this. So over to you, Arturo. Thanks very much.
Thank you, Fiona, and hi, everybody. I haven't, this is the first time that you hear my voice. I've been in the back answering your very interesting questions, so another invitation to keep them coming. So now we're, again, as Fiona said, moving on to our final unit of this training. We have gone through prepare, align, implement, and now we're focusing on communicating. This section focuses on the when and where of disclosure of sustainability-related financial informations. So the section includes three main sections that you can see on your screen: location and timing, efficiency, and confidence. So we'll start with the first one, which is location, where disclosure should appear when you're preparing ISSB aligned disclosures. So before we dive into the specific requirements, let's think about sustainability disclosures in the context of a complete reporting package that is useful to investors. The requirements in ISSB standards are based on investor information needs, as we've discussed a lot during this session, and they build on past standards and frameworks such as TCFD and SASB, which were similarly developed with investors in mind. One of the major advances in the ISSB standards is that it brings the rigor of accounting as well as connectivity to the financial statements. ISSB and GRI standards share some content requirements, that is, what to report, but with different objectives. Let's remember that the ISSB standards are super laser focused on the investors' needs for information that helps them with their decision making. That is, information about sustainability-related risks and opportunities that could reasonably be expected to affect a company's cash flows, access to finance, or cost of capital, as we've discussed before. Meanwhile, the objective of the GRI standards is to elicit information about a company's impacts, regardless of the implication for those impacts on the company's performance. As a result, the ISSB and GRI take different, and you might say, complementary approaches to materiality, and we've seen a few questions regarding the differences between ISSB and GRI on our Q&A. The GRI is commonly understood among sustainability practitioners, whereas the IFRS approach is familiar to the accounting professionals in this call, as well as financial executives, investor relationship professionals, and relies heavily on management judgment. In short, many of the impacts traditionally identified as material in the GRI standards may give rise to sustainability-related risk and opportunities that are likely to affect a company's prospects and therefore end up in an ISSB-aligned report. So now let's move on. What is material information? Given that we hear references to different types of materiality from different reporting standards and frameworks, let's briefly recap here what we mean by material information. Again, we've seen this concept of materiality a lot today, but let's just recap what that means. As we discussed in our first module, information is material when it influences the decisions of primary users of general purpose financial reports and informs their decisions about providing resources to the company, buying, selling, or holding equity and debt investments, granting loans and other forms of credit, or voting on or influencing how management uses a company's economic resources. So in this context, when preparing our disclosures, we need to consider the characteristics of the investors and the company's own circumstances. For example, different investors can have different and sometimes conflicting informational needs. Sustainability-related financial disclosures are intended to meet the common denominator, the common information needs of investors. So again, when you're preparing these disclosures, think of what your average investors would need and what are the common informational needs of your investors base. One very important thing to remember is that materiality is a characteristic of information. The ISSB standards take a two-level approach. First, you need to identify which sustainability-related risk and opportunities would investors expect to affect a company's prospects, and then what material information about those risks and opportunities would you need to report to inform their decisions, that is, of the investors. So if we move on to the next slide, sorry, one before. We see that IFRS 1 requires that material information be clearly identifiable and that it's clear and concise. Material information, in other words, should not be obscured by other non-material information. And let's talk briefly about why this is important. First, the location of sustainability-related financial information within general purpose financial reports may vary between companies across different jurisdictions. One company may be required to include this information in annual reports. One company in another jurisdiction may include this in a sustainability report due to regulation. So again, the location of sustainability-related financial information varies. And the second one is information is designed to meet the needs of other stakeholders in addition to investors. And it might be provided on a voluntary basis to meet regulatory requirements. The potential problem is that material information could be obscured because it is buried amongst immaterial information, or because the report is poorly organized and material information is scattered throughout the report. So a company may not assert compliance with ISSB standards if a report is overloaded with irrelevant data or if it blends information for different audiences beyond investors. Remember, the specific audience of ISSB standards is investors. So what we're trying to achieve here is for data aligned with ISSB to be clearly identified and concise so that investors can identify it very quickly and, of course, use that information to inform their decision making. So now let's do a quick Zoom poll. The question you should see in your screens. Information should be disclosed in the annual report when applying the ISSB standards if, and you can select all that apply. So let's give the audience a few more seconds. We have over 200 responses now. So a couple of more seconds and we will share the responses. So most of you have chosen option A and B, which are the correct options. Information should be disclosed if omitting that information could reasonably be expected to influence investor decisions. As we said, all our focus with ISSB standards is on meeting the informational needs of investors, and if it could reasonably expected to affect the entity's cash flows. So A and B were correct. Thank you for participating. So now let's move on to where to report information that is aligned with ISSB standards. So disclosure under the ISSB standards must be made available at the same time and on the same terms as the financial statements. That is, as part of the same general purpose financial reporting package. Remember that we're trying to create a coherent story between the financial information and the sustainability financial information. However, it's important to remember that S1 does not have a specific requirements on the exact placement of that information. That is, it does not say where within that reporting package the information shall be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. So again, the idea is for this information to be part of the general purpose financial reports of that package, but it doesn't say specifically in what document, as long as it is part of that package of information given to investors. The most important factor to consider here is to ensure that sustainability disclosures are for the same reporting entity as the related financial statements and are published as part of the entity's general purpose financial reports and at the same time as the financial statements, covering also the same reporting period. So again, trying to convey a coherent story between financial statements and the sustainability related financial information disclosed by companies. So next, I'll hand it over to Luis for an example regarding the where and when.
Thanks, Arturo. Yes, and rather than giving a specific corporate example here, we're giving an overview of current practices reflecting where companies are reporting information. And this comes from the World Business Council for Sustainability, their 2025 Reporting Matters report, which is an annual review of corporate reporting from a selection of global companies. So what we see here is that standalone sustainability reports remain the predominant approach in 2025, comprising 54% of reports in this year's sample, and combined reports have increased too. This shift that we see from 2024 to 25 shows that reporting of financial and non-financial information within the same document is increasing, and this is in line with regulatory requirements. So there's an increase in combining these reports. And this is possibly, you can see below that the WBCSD have also done an analysis of this by region. So we can see in the Americas that standalone reporting remains, most popular. They predominate with 81%. Compare that with Europe, where you see that the standalone report is only 39%, combined reports being 42%. And perhaps this is a response to regulatory shifts in Europe. So really the main message to take away from here is there's a range of practice. There appears to be a trend of more combined reports where sustainability information is not so much in a standalone report, but in the general purpose financial report as ISSB requires. But this presupposes that your information is in a PDF, but Arturo is going to tell us now about the evolution towards digital reporting.
Thanks, Luis. So yeah, let's in fact now talk briefly about the evolution to digital reporting and how the ISSB is responding to that trend. So increasingly, as you might have seen, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those data sets offered by the stock exchanges or regulators. And to respond to this reality, the IFRS Foundation developed the ISSB taxonomy. The ISSB taxonomy provides identifiers or tags if we're using the XBRL language, which is a technology for digital taxonomies. So these tags are needed to make sustainability disclosures machine readable. We know that AI and new technologies are on the rise, and they will be more and more used in the future to analyze reports, analyze data from those reports. So these tags available through technologies like XBRL are helpful to identify pieces of data that are machine readable. This makes it easier for investors and data platforms to take large data sets like information from an entire industry, for example, and bring them all together to analyze them. And digital reporting has several benefits, as you may already think. First, it makes the reported information easier to use for analyses because data is structured the same way across businesses, sectors, industries, jurisdictions, and is readable in a machine format for machines for algorithms. Second, tagging information potentially allows for automated checks for quality and consistency, sorry. Third, it improves processing and report preparation as more data collection and management systems are compatible with digital reporting taxonomies. And finally, tags can have labels and descriptions in multiple languages. So if you're reporting your quantitative data in one language, someone is speaking another language can also understand what it means just by referring to those tags that I mentioned earlier. So now let's move to the second part of our communication section, which focuses on how to communicate efficiently and effectively with your main audience, which again is investors in the case of ISSB standards. So first, it's important to understand what effective communication looks like and what is required in our standards. Often companies think that if they just pull all the information they have into one report, then everyone will be happy and satisfied. However, these would be against the core concepts, in particular the fair presentation and this idea of focusing only on material information. ISSB requires information to be clear and concise. Remember that. And the clearest form a disclosure can take will depend on the nature of the information. For example, conciseness can be obtained via tables, graphs, diagrams, plus some accompanying qualitative text. So to be concise, disclosures need to avoid boilerplate information, as we said earlier, unnecessary duplication, as well as using a clear, concise language. Now, let's spend a few seconds talking about the quality of information to report and how traditionally disclosure of sustainability information and financial information has been different. Accountants in the audience are probably familiar with the rigor that's required in data collection, oversight, sign-off, and external assurance if a company seeks external assurance for general purpose financial reports. The same level of rigor has not been traditionally linked with sustainability information. For example, comparable information from the previous reporting period is a requirement in the ISSB standards, except during the first year of implementation, and it must be revised if necessary. And as we discussed in the previous sections, the ISSB standards require that reported information shall be material and that companies provide connected information, including highlighted connections between the sustainability risks and opportunities that they are mentioning in their report, the core content areas of governance, strategy, risk management, and metrics and targets, and of course, connectivity between sustainability-related financial information and the financial statements. So when aggregating information, items of information shall be aggregated if they have shared characteristics and disaggregated if they do not. A company shall not aggregate information if doing so would obscure material information. And as we've said before, companies should also avoid unnecessary duplication and cross-references appropriately. So now that we've mentioned cross-referencing, let's remember that cross-referencing is allowed within the ISSB standards. And as you may have already noticed, there may appear to be some overlap in the topics covered in and the information disclosed across different reports or sections of reports. In fact, IFRS 1 requires you to avoid unnecessary duplication. So let's give you an example. If you have the same governance approach across all sustainability issues, you need only disclose it once, right? So if you have one sustainability committee that looks at sustainability risks and opportunities and also climate, you can only report that structure once because it looks at both sustainability and climate instead of reporting it twice, one for S1 and one for S2. So remember that cross-referencing shall be applied consistently and transparently across the document, and it shall not result in the information becoming obscured or more difficult to understand. And again, ISSB standards do allow for cross-referencing when needed for disclosures, but always remembering that information needs to be clearly identifiable and precise. And let's now go to Lewis for an example from a mining company. Lewis.
Thank you, Arturo. Very, very simple example here from ArcelorMittal from their 2024 sustainability report. This is a steel manufacturing company. What we see here is that ArcelorMittal mapped the areas of their 2024 reporting outputs to where we can find information. So in the left-hand column, under the title Content Element or Concept, all of these words will be very familiar to you now after our training today. We see governance, risks and opportunities, strategy and resource allocation, etc. And what we find in the table under the title Our Response is that the company directs the reader to where they can find information about these subjects. So interestingly, in some cases, information is to be found within the sustainability report. So if we look at governance, we can find more information within the same report under governance and risk management. In other cases, you can find more information both within the report and elsewhere. So if you look at risks and opportunities, we are cross-referred to the company's Form 20F, which is a US required annual registration document. So just a little table to show the reader quickly and simply where they can find information about the ISSB content elements. Back to you, Arturo.
Thanks, Lewis. It's always great to see those examples. Let's now talk about mechanisms that support the adoption of these standards and the implementation of these standards. As you may imagine, the ISSB has been has sought to apply several mechanisms to support preparers getting started with the ISSB standards. And one simple thing put in place at the beginning of the creation of the standards was to adopt well-known terminology and concepts familiar to preparers and borrowing from IASB, for example. And we talked about the materiality concept quite extensively today. As you might have heard, that definition comes from the IASB standards, the accounting standards. So the challenge for preparers is not to understand something new, to learn a new concept, but to apply that concept into a different context, in this case, from financial to sustainability reporting. Many requirements in both IFRS 1 and IFRS 2 are to be applied proportionately, recognizing companies will have a range of capabilities, skills, and resources and levels of preparedness to comply with these requirements. So for example, qualitative scenario analysis is permitted under certain circumstances because the ISSB standards do include two proportionality mechanisms. The first one is the use of all reasonable and supportable information that a company has at the reporting date without undue cost and effort. And the second type of proportionality mechanisms is the possibility to provide qualitative information based on the skills, capabilities, and resources of a company. It's important to remember that these proportionality mechanisms do not apply to the entirety of the standards. They apply to specific elements within these standards. So be very careful when reading these standards. When these phrases appear, that means that one of those two proportionality mechanisms apply to that specific requirement. These standards also include relief provisions for the first year of application, and these relief provisions basically give an extra year for companies to prepare certain requirements within these standards. So just to give you an example, companies are able to limit their disclosures to climate only during the first year of implementation, and then during the second year, expand that disclosure to other sustainability risks and opportunities that are not climate related. Companies are also allowed to report their sustainability-related financial information, not at the same time as their financial reports during the first year, but after the first year, again, that reporting has to be done at the same time. Another example is relating to Scope 3 greenhouse gas emissions. Companies know that measuring and reporting these emissions is hard because they, of course, encompass the entire value chain. So because of this fact that these are emissions that are harder to measure and disclose, the ISSB is given an extra year for companies to compile this information and report that data. So let's go now to two Zoom questions. The first one you see on your screen. Information disclosed in accordance with the ISSB should be A, decision useful, B, material, C, misleading, D, comparable. And we'll give maybe 15 seconds for people to respond and then look at the results. So I think we can end the poll now because the answers are very, very clear. A, B, and D are the correct answers. You want information to be decision useful for investors. Therefore, it needs to be material for their decision making and comparable across time and across companies within the same industry. So let's do one more poll. Information is decision useful if it is A, relevant and faithfully represents what it purports to represent, comparable, verifiable, timely, and understandable. So again, we'll give maybe 10, 15 seconds for people to answer the question, and we'll look at the results. So we have over 300 responses now, and we can probably show the results. Literally, in this case, there is no incorrect answer. All of those items that you see on the screen are characteristics of decision useful information, right? Relevant, comparable, verifiable, timely, and understandable. And all of these definitions of what information should be are found in the first sections of IFRS S1. So back to the presentation. We have now reached the final part of our communication section. And this has to do with maximizing the confidence in the information you are disclosing to your investors and providers of capital. So let's talk about comparative information. An important way to build trust with your investors and providers of capital is showing data and trends over time. And IFRS S1 requires that entities disclose comparative information for the preceding period for all amounts disclosed and for qualitative or narrative information that is useful to investors. Of course, during the first year of application, you don't need to provide comparative information because it's the first year of application and you don't have anything to compare with. But comparative information provides context, helps to indicate progress, and underpins strategy and risk management, and it can be both quantitative and qualitative. Metrics disclosed by a company might be refined or replaced over time, or the company might change its method for estimating a metric. If this is the case, if metrics change over time, it is important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. And also, if you have new information for last year, for example, if you obtained actual greenhouse gas information this year from your supply chain that in previous year you had only estimated, then you should revise the information if that information is material to your investors. And occasionally, a company's sustainability disclosures might contain material errors. We are all humans, and errors are part of these standards. Accounting for errors is part of these standards. So in this situation, if a company does identify an error, it is required to restate these errors in the comparatives provided. Revisions or restatements are necessary only when there is a risk of material information being omitted, misstated, or obscured because of not revising or restating those comparatives. Now, let's talk about the statement of compliance. Another way to build trust and confidence with your audience is providing a clear statement of compliance that you are applying the ISSB standards in their entirety. So a company that complies with all the requirements in the ISSB standards, even including the reliefs, is required to make an explicit statement of compliance. This is very common for traditional reporting in accounting. So the same concept is being translated here for sustainability reporting. I want to emphasize that you can still make a statement of compliance if you are using transitional reliefs, because these are part of the standards in the first year of reporting, or if you're ever using any of the proportionality mechanisms that we discussed previously. So even if you're using transitional reliefs, and even if you're using all reasonable and supportable information without undue cost and effort, or providing qualitative disclosures for specific requirements based on your skills, resources, and capabilities, you can still say that you are complying with the ISSB standards because, again, these reliefs and proportionality mechanisms are part of the standards. There are two exceptions where information could be omitted and you could still make a statement of compliance. The first one is when you have commercially sensitive information and you do not need to disclose this information because you may be losing your competitive edge within your industry and among your competitors. But note that this only applies to sustainability opportunities and not risks. And the second exception is when you are prohibited to provide any information by law or regulation. So there may be cases where a particular regulator in a particular jurisdiction does not allow you to report certain information. And if that is the case, of course, that local law or regulation overrides the requirements in IFRS standards. So companies that are beginning to phase in the ISSB standards voluntarily and are not partially aligned to them cannot make a statement of compliance. Remember, you need to comply with all requirements within the standards to say that you are complying with these standards. If you're only partially aligning with that, you cannot include that statement of compliance, but you can say that you are working towards full alignment. So a few things to remember to wrap up this last unit. Here are some things to remember about disclosing effectively, efficiently, and building confidence with your audience. Follow the requirements for fair representation in the conceptual foundations of IFRS S1. This includes the fundamental characteristics of decision useful information. Information, again, shall be relevant, shall be material, shall be faithfully represented to avoid greenwashing. It needs to be complete, neutral, and accurate. Then there are enhancing characteristics of information. That is, that information should be comparable, verifiable, timely, and understandable. Also, make sure that information is provided to investors so that investors can understand connections between risk and opportunities, between disclosures about them, and of course, between the financial statements and sustainability-related financial disclosures. And finally, the ISSB disclosure should be for the same reporting entity and the same period as the financial statements, published at the same time with complete material information, comparatives for the previous period, and include a statement of compliance. You can find in the handbook slide deck an additional slide in this section with reminders on how to report effectively. And that, of course, will be shared after our session ends today. So back to Fiona.
Brilliant. Thank you, Arturo, for taking us through that last module together. So in our final few minutes then, let's wrap up our training. So just to highlight, I think, a few key things that were mentioned here. So clarity in your audience, of course, is really important. And keeping in mind that for the IFRS standards, we're focusing here on that primary audience of investors and using that to guide our information needs. We then talked about efficiency, and the key takeaway here being that less is more. So we're not trying to overload our investors with information, but really to use the standards to focus on what investors really need to know about. And then finally, we talked there about report user confidence. So, of course, in the current climate where there can be quite heavy scrutiny over disclosures, it's important that we're making sure our data is accurate and we're presenting in a way that builds trust among report users. Okay, so that wraps us up on our last module. In the interest of time, we will skip our last exercise, so not to worry, but encourage you to take a look at the disclosure plan homework exercise if you'd like to continue your thinking on the same questions. But a little question to revisit in Menti now is just to get a sense of how comfortable everyone is on those disclosure or kind of learning objectives that we started out with at the beginning of today's session. So I've shared the link, and it'd be great if you could let us know by voting in Menti how comfortable you are now with the different tasks. I'm seeing from the responses so far that we've got most people sort of up in the 3s and 4s on the scale now. So great to see a lot of you feeling much more confident. But in the interest of time, I'll leave you to respond to that in the background whilst I just present a few wrap-up slides. So firstly, as I've mentioned, the homework assignment. This isn't mandatory. It's not something you're expected to do. You don't need to submit it to us, but we've developed this to help you build out that disclosure plan. As we've said, a disclosure plan isn't required, but we think it's a really useful structure to help you organize and sequence your approach to disclosures. So the structure of that homework assignment aligns with the exercises we've done together today. So encourage you to take a look at that on the event page for today's session that we've shared the link to a number of times, and we'll reshare again in the chat if you'd like to continue to use that exercise to take forward your learning. And highlighting a number of other resources you can use on that point to help with your learning. Firstly, I would like to mention the IFRS Knowledge Hub, a really great go-to resource, of course, for everything that we've talked about today from the IFRS team in terms of their standards, educational material, case studies, and indeed some more e-learning modules as well that you can also take part in there. I'll also highlight the work of the IFC team, who of course support this training as well. They have a great program called Beyond the Balance Sheet, which provides you with a whole host of different resources there as well. And they've also recently developed another e-learning course called Sustainability Reporting Essentials, which could be really useful to check out as well. And you'll find the link to that there on the slide. From the SSE side, we've mentioned already our toolkit. So just as a reminder, you can find the link to access this in the slide handout or go to the publication section of the SSE webpage. But of course, as we're coming to our final moments, I know a very important question you'll all have on your minds is how to get your certificate. So we're going to share a link in the chat with you now, and I might ask the team to post it a couple of times just with lots of messages. That link to the feedback survey is what you'll need to fill out to receive your CPD certificate. If you missed the link in the chat, if you've attended live with us today, you'll also get sent that link again in 24 hours time in an email from Zoom. So make sure to look out for that email from Zoom with the link to the feedback survey, or take a look for that in the chat now. If you fill out that survey and give us around a week, we'll be able to send you your certificate as well. Make sure to check your junk folder if your spam filters might have sent the certificate there as well, in case you might have any issues accessing it. But as we're closing, just a few final words of appreciation. Firstly, a big thank you to all of the SSE's supporters, a group of stock exchanges and organisations who are really helping to support sustainable capital markets and help to make this training possible. So feel free to contact us if you're interested in becoming an official supporter. And of course, a massive thank you to all of our partners on today's training, to our colleagues at IFC and the IFRS Foundation, and particularly to Robert, Arturo, Veronica and Visvesh for all of your support to the team today in answering the questions and presenting. So We'll close out our session there, but my final thanks, of course, is to all of you as participants who've taken the time to join us today and to continue your learning on this topic. So wishing you all of the best with taking this forward, and we hope to see you again on a future SSE workshop. So have a great rest of your day, everyone, and take care.